Good afternoon, everyone. For those of you who are Motley Fool members who went through our brief little pause there, thanks for sticking around with us. And for everyone who is now joining us on YouTube Live, welcome to Fool24. My name is Crowe. I'll be doing an hour with Seth, Jayson here with a nice little theme of chips, clouds, and more. Seth definitely being the chips and clouds guy, and I kind of being a little bit more the more guy.
So it never ends up being chips and clouds either. People just ask
it can just end up going anywhere.
Yeah.
So before we do get started, though, just a couple quick things just for the new people joining us from YouTube. Just the disclosure that we always start with. We're going to be giving our thoughts, our views, expertise, maybe less than expert advice on a few things every once in a while, but these are our own views, and please don't misconstrue this for what would be considered personalized, individualized advice. That's up to you to make your own decisions. And if you really do have questions on your personal finance questions, I would implore you to go seek from a professional. Also, for our YouTube audience who are just joining us, you can, if you want to get questions in, we do not use the comments section for YouTube. So go on over to slido.com and enter the code Fool24, and you can ask questions there. And we'll try to get to as many as we can over the next hour. So, Jayson, you and I have, Seth, Jayson, we haven't done one of these actually before together. So I'm going to be really interested. It's going to be fun.
Yeah. Well, when I came back, when I was in the green room, as it were, they were leaving. They were talking running shoes and stuff toward the end there. Something I know a lot about as a runner and a sometimes shoe company investor. So we've been getting a lot of discussion of that on Fool24 lately. And so people are, people are asking a lot about Nike and on running. And what's interesting to me the other day, On is kind of an up and coming shoe outfit. And I've always been saying, mostly I see On sneakers like on my optometrist or my ophthalmologist or my orthodontist in the office. I don't see them out on the running trail very often. And one of the things I know the other day is, and I always talk about how I go to a lot of track meets and the kids wear Nikes, that the competition shoe is like 90% Nike. That's just Nike's got that market wrapped up, and it's not just the brand. They make really good, running spikes and so forth. But my kid's coach sent me something. They said, look, these On spikes, they're on sale. They're like half off. So they were like $80 instead of 160 or whatever they had originally been. So I was trying to dig up some more information on them. The weight on them just seemed funny to me. They were listed as being lighter than Nike's lightest spike, except they had more cushion in them. And I thought, like, how is that possible? I can see from the construction, it's a more robust construction. How can it be lighter? Anyway, I went down the rabbit hole and I figured out the reason they were getting rid of these is they were illegal. They weren't going to be allowed anymore. So one of the interesting things about running shoe tech over the past few years is that everybody copied the maximalist shoe thing, and they figured out very quickly that more foam and bouncier foam was the key to faster times. Carbon plates got a lot of press, but the carbon plate wasn't really a catapult like people said, nor was it a spring. The spring is the foam. So the World Athletic Associations basically had to say you can have a maximum of this much foam in a road shoe, or it's illegal. And they did the same thing recently, or going into the Paris Olympics for track shoes. And so these On shoes were actually on sale because they are not legal in college or in any international competition. You could still use them in high school. At least in a lot of states, they haven't done it. But I thought it was funny. I said, you know what, I'm just going to skip them because she might as well get used to running in the legal shoes. The interesting thing about Nike as an investment in the others is that, like, how much of the brand is fashion and how much of it is performance, and how much does the performance matter and the performance halo matter in order to kind of give street cred to the fashionability. It's always a tough juggling act, right?
Yeah, it's hard for me to think of it that way because I'm a New Balance guy. Actually, I did my 9 miles today, and I was like, oh,
There you
it
go.
was feeling really good. But there's nothing pretty about a very cushiony New Balance shoe in any way.
And one of the ones that came along and was like, okay, if the market is on these really thick shoes, we'll do it. And they came up with some really good tech. I tried one out not long ago. My feet, it didn't fit my feet. My feet are really skinny, and the New Balance last tends to be wider. But
yeah, but it's kind of interesting because we've seen these stocks. The investment. You look at Deckers Outdoor, which is Hoka mostly now. I think at this point they're primarily a Hoka business.
that's where the
In terms of
growth is.
tools.
Yeah, at least UGG is probably still hanging in there, but it's not the growth engine that Hoka is.
Not much. So you've got Hoka, you've got On Holdings, Nike, and then to a lesser. There's been some other mention of fashion forward footwear and questions like that in our Slido related to that. And to me, I don't know if it's a recession thing or if it's just a valuation thing, because a lot of these companies, like much of the market, I think were priced for pretty high growth that I think would be hard to achieve in just about any market. And obviously Nike is unique in the sense of where it's kind of going through that. We'll call it the picking themselves up after the direct-to-consumer push that may have alienated some of its more traditional retail partners or something like that.
Yeah.
Maybe slightly different story than like the Deckers or the On Holdings or anything like that. But for most of the questions that I've seen shoe related, the thing I seem to chalk it up to is it just expectations may have run faster than the growth that these companies could sustain over the long term.
Yeah, and a lot of the revenue growth, in my opinion, was, as somebody who buys running shoes, seems to me like it was driven by increasing prices per shoe. And at some point, like, we're going to put our foot down and just say, like, we can't afford these. I mean, the shoes I liked that were $120 a pair 5 years ago are like 180 now, and they don't have that much more going on in them, and they're still made over like in Vietnam or something. So there's a point at which they are not going to be able to increase revenues by just jacking up the prices.
Yeah.
But I don't even know who owns New Balance these days. I know
it's private.
It's private. Okay. Because Saucony, if I'm not incorrect, and Merrill are owned by Wolverine Worldwide, which is, better known for boots and things too. And so, but New Balance still remains private. There we go. Let's take a look at some of our questions here. This one, I guess, is a little bit related. Roy asks, hey guys, this is from last hour. What luxury stock may do well in a downturn? That one is interesting. In general, I think luxury stocks do poorly in downturns because a lot of luxury business, or at least some of it, is marginal. Some of it is people stepping up, right? And people who aren't really luxury people spending on luxuries. And once they're gone, you drop your revenues. There may be one company I can think of that wouldn't have that problem. And I think it might be Ferrari.
I was going to say the exact same thing.
Wow, that's crazy. And I own Ferrari stock. I've owned it for a long time. I love Ferrari cars. Would never buy one just because, one, they wouldn't let me into the dealership looking like this, but two, like, where would I park it? I'd worry about it all the time. But Ferrari probably has a clientele that is going to be relatively insulated from just about any economic environment that we can imagine.
Yeah, and when it comes to luxury, I can't think of a lot of American, like, ones that are publicly traded in the U.S. that are like recession proof or recession resilient, because a lot of them I think have done like the luxury at a bargain price sort of like approach, like the Coach and things like that, where they've had a little bit more of a mass market appeal that erodes its pricing power and that exclusivity that is typically associated with luxury. One of the if I was to, aside from Ferrari, which again, like, it's not a car company. If anybody is an auto analyst and is looking Ferrari, it's like a whole different ballgame. Outside of like Ferrari, I think the only ones that it would probably be like some of the internationally traded ones like Hermes or LVMH Holdings. But even LVMH is so diversified into things like liquor that I could definitely see that having its own issues, maybe not across its entire portfolio, but enough weak points that it wouldn't, be firing on all cylinders, if you will.
Yeah. For one other thing you might take from Ferrari, and I don't know who else this would apply to, but like if the entire production is sort of already spoken for before they're even showing them out the back door of the factory, and there's a wait list, probably fairly recession proof, or as recession proof as you're likely to find. And that's the case for Ferrari. And if there's another one out there, put the comments in the Slido, because I don't think we could think of it. So what else?
I'm trying to think. That I'm looking for anything. We're getting a lot of questions on shoes. Apparently, instead of chips, clouds, and Morris, be chips, clouds, and
love it.
footwear.
Well, we got Monolithic Power too from BLSH. I spoke about them a couple of days ago. Monolithic Power, they had their earnings out a few weeks ago. They looked pretty good. They had good growth in some of the markets that had not done as well, in prior quarters. And that's kind of the story with Monolithic Power. So if people aren't familiar, Monolithic Power makes thousands of products, and they're basically DC electrical converters for inside of just about anything you can think of, like, radio, nav units in cars, computer boards, cell phones, just about everything, robots, drones, and then very famously, Nvidia GPUs that are going into AI data centers. And this was a major growth avenue over the past couple of years, and the stock went flying, and everybody called it an AI stock. And that actually kind of bothered the management. The management was like, yes, we sell a lot of this right now, but like, we're not an AI stock. We make lots of stuff for lots of other OEMs, and that's what we do. And they are, I looked at the results, and the stock, has been beaten down with everything else lately. It hasn't done too badly compared to some other stocks. If you bought it a couple of months ago, after it took a big fall, like 9 months ago, because the expectations were lowered. Still looks like a great operator to me. Still really good free cash flow margins, upping the dividend. And like I said, doing well in many different end markets. And so, there's always one that's up and one that's down. Sure, if data center went really badly, you'd see some short to medium term revenue drawdowns. However, they're just everywhere, and they just keep putting more products inside of other products. And I don't see that stopping anytime soon. And so it's just a stock that, even though it looks a little pricey, is probably a decent value among the pricey techie stocks these days, at least in my opinion.
Seth, who would you say is like Monolithic Power's biggest competitor? Because it seems like one of those like niche components of the not semiconductor, if you will, but as you said, like the DC controllable
Yeah, I would have to look and see who they name in their filings. Honestly, I think that they're one of those companies that has the competition is everyone and no one in some ways. One of the things when I was speaking about it last week or earlier in the week with Dave Meyer was that if you look at their gross margins, it's clear that sort of they don't have. I don't know. I shouldn't say they don't have competition, because they always say we have competition. Other companies do get approached to make these products, and then are like qualified to go into, say, the Nvidia cards. And we expect that anybody selling a zillion units of something like Nvidia would want to have more than one supplier, even if that's not us. However, when you look at the gross margins, they tend to hold up pretty well. They look pretty good. So to me, that's an indicator that yeah, there's competition, but it's not the kind of competition that is just becoming a race to the bottom for everyone involved, because this company is not involved in a race to the bottom. The margins just show it. So I don't know who I would name specifically. I would grab the 10K and say who and ask what, look to the competition section and see who they're worried about.
It's fun. The more and more I read 10Ks, though, I find fewer companies are directly naming competitors. I don't know if you've run into that as much recently, but I've been doing a lot of like 10K dives, and it'll say like, we have lots of competitors, and the people they name seems to be shockingly few when it comes to this. Perhaps
Yeah,
it's
and
just
then
the fields that I'm working in, but
yeah, and it depends on the company. You know what I'm going to do? I'm going to use an AI here. Hang on a sec.
all right. So while you do that, though, and we can revisit this one in just a second, but I thought I would take out this one really quick because Sarah E asked a question about 25 minutes ago, and I can hit this one pretty quick because I've done this one previously. But Sarah E was asking if Whirlpool, of the appliance company, ticker WHR, if that's still a buy. And so after its like 10K or 2024 results came out and 2025 projections, the thing that I kind of looked at it seemed like it was projecting, I wouldn't call it like great results, and a little bit, I would say ambitious. They were projecting flat growth in the United States and like mid to single digit earnings before interest and taxes margins, which is fine, but not great. But the thing that immediately stood out to me was like when they made their projections, there was like zero assumptions for tariffs, and steel appliances. Steel costs are a big component of what they do. There's really no getting around that. They're not one of the appliances are nice and they do some work with it, but it's not like one of these highly engineered solutions where like the labor that you're putting into it is miles more than your raw material costs. So a company like Whirlpool could be affected much more by margins than other companies that are appliance end product user of steel, something like that. The good news for most people who are looking at Whirlpool, because it has a dividend yield of 7.7%. And I think a lot of people will look at it and be like, well, that's really high for them. And maybe they're looking at a dividend cut, but it still seems like they're cash generative enough that they can at least cover what they're doing right now. They're expecting $1 to $1.1 billion in free cash flow. Seems a little ambitious, but we'll see. Again, very tariff related. And so, there's part of me that just says like, I felt like management was just a little too ambitious with like what their projections were for 2025 and didn't have a lot of downside baked into what they were doing. If we were to see, a slowdown, if we were to see cost impacts related to tariffs and all these things seem like very realistic outcomes over the next couple of months, quarters, years. It doesn't look quite as attractive, and that 7.7% dividend yield does kind of hint like, hey, maybe they might have to do something to free up some cash, which would likely mean like a trim of its dividend. So as far as like Whirlpool, to me, it's kind of just let's kind of sit on the sidelines and see what happens.
Yeah, I use a spreadsheet that puts up 10 years worth of data. So you'll often see me staring like this, and I'm actually dropping a ticker in, it pulls in all the data. It pulls in like, I don't know how many 10,000 cells worth of data. And it shows me like revenue versus various measures of cash flow, margins, and so on. And Whirlpool is one of those ones that's never been that exciting to me. The revenue profile trending down over the past couple of years. And then like gross margins, 15%-ish, operating margins heading down in the 5.4% range, and just like not a ton of free cash flow production. What have I got here? I got, I saw they did like 1.2 billion a couple of years ago, but free cash flow margin, I don't see where it is there, but 630 million free cash flow on 16 billion in sales. So that's pretty decent. But the stock trades at a free cash flow yield of 3.3%, yet the dividend yield is 7.6%. It's starting to, with things looking the way they are, I'm with you. It's starting to look iffy, and whenever those dividends get like above like 7% in this kind of a climate, you start to worry that there's something there that you're missing, and other people may be missing too.
The one thing about like it's kind of historicals that I have a hard time contextualizing though is they did just sell it's their European manufacturing and their European assets and brought in like a joint venture partner from Turkey, so a little bit lower cost production centers and things like that. So maybe there's a chance for higher margins because they can outsource some of the costs there and have a little bit more of a tailored capital structure towards that. But I think that's still like kind of just dancing around the margins here.
Yeah, it's tough to figure out where those moving pieces are going to end up, right? So it's tough. So I wanted to get back quickly to the competitors for Monolithic Power. So I did an AI, and the AI that I did was, we have a very good system that when you use a generative search, it actually goes to the filings and digs things out for you. And with one click, you can figure out whether or not it has hallucinated or not. And in this case, it does not appear to have. So if you look at Monolithic Power's 10K, latest 10K, they list their primary competitors to include Analog Devices, Infineon, NXP, On Semiconductor, Power Integrations, Renesas, ROHM, Semtech, ST Microelectronics, and Texas Instruments. So it is sort of everybody and nobody in a way. And so there's your answer. Lots of competition in the space, yet they continue to do well and get kind of pretty good margins on their stuff, which indicates that the OEMs buying this stuff are happy with it and willing to pay.
It looks like Besties helped us out too, giving us some of Monolithic Power's competitors in the comments. So thanks on that. While you are looking up for some questions here, I saw Sadaf asked one for me related to the ticker AMR and HCC, which is Alpha Metallurgical Resources and Warrior Met Coal, because we're going to have a metallurgical coal discussion here. I know that's the gripping conversation that a lot of people were looking for a chips and cloud conversation. But you know what? Here we go. As for those of you who aren't necessarily familiar with the coal market, there are two types. There's thermal coal, which we use in power plants, and then there's metallurgical coal, which is used as a way to transform iron ore into steel. It's called a reduction agent. Basically, it's hot, really, really hot and devoid of oxygen. So it strips out all the oxygen from the iron ore, and it gives you that nice, sweet ferrous alloy when you're all done. The one with Warrior Met Coal and Alpha Metallurgical Resources, both of these companies are highly dependent on the exports because met coal, for the most, we have blast furnaces in the United States, but as a percentage of total steel production in the United States, we have moved more and more to what are called electric arc mini mills, which use basically electricity. It's like they stick two graphite rods in like waste metal, and it melts it down and doesn't use a reducing agent like coal or anything like that anymore. So domestic demand for metallurgical coal is kind of weight. So you're mostly looking at the export market. And when I say the export market, it's kind of a euphemism for saying exporting to China, because China has obviously the largest steel production capacity in the world. It's not even close. You talk about just about any metal these days, or something like that, smelting copper or producing iron ore to steel. China somewhere is like between 30 and 50% of the global market in terms of capacity for doing this. And so you're selling to the Chinese market. And, there has been, the data is a little less complete, but, we've seen a slowdown in Chinese construction, the real estate development, construction industry. So that's going to, significantly reduce steel demand. And at the same time, this is probably just price related, at least stock price. I'm sure there's some people who are looking at these companies and thinking, well, tit for tat tariffs, metallurgical coal could become a component of that. I'm not sure if it's realistic or not. It's just kind of one of those, the thing in the back of your head, kind of you saying, hey, this might happen. So I don't know. This is an industry where you can see the outlook for metallurgical coal looks better than thermal, but I don't necessarily know if it's great either. Now, these companies are all trading, both Alpha and Warrior Met are trading somewhere between 9.5 and 11 times earnings. So there's not a lot of big upside built into these things. It's more or less kind of priced as if it's going to do what it does for, zero growth, zero, revenue or anything like that, and just trying to milk the cash that you can out of this business for a while. And as much as I can appreciate a business that does that, I just can't seem to get excited for metallurgical coal stocks when it comes to that.
as an investor, you think there's any room for them to jack up their prices if the American steel producers jack up their prices, which is what they have done and will do if the competing foreign steel is more expensive? If your competitor has to sell it at X plus 25% and you can sell it at X plus 20, right? You'll do it. Is there any room for them? Is there any room for the metallurgical coal companies to kind of coattail on that? Not really.
I would say Paquito, because I think it's one of those things where, again, like, yes, they can, maybe they might be able to sell a little bit higher in the US market, but, you know, exports is such a big component of their overall revenue base that it's, I don't know, it seems like it might come out in the wash.
Yeah. Yeah. So I grew up in the mining area of the United States, up in northern Minnesota, a place called the Iron Range, where the holes in the ground are 10 to 20 times bigger than the towns next to the holes in the ground. We still have a cabin up there. And so I can, you know, next time I'll get you a handful of pellets next time I'm riding over a railroad track, because they
good chance it's a Cleveland Cliffs mine too.
They always spill out. There's a couple of them up there. Yep. Anyway, we had a couple more questions here. One of them was on Academy Sports and Outdoor. I don't think I have checked in with them for quite a while. What do I think of Academy Sports and Outdoors? Again, put it into my handy dandy sheet. So one of the first things I look at for a company like this, which is slightly downtrending top line over the past 4 to 5 years, is like, what's the free cash flow yield? And it's, 9.1%. However, a lot of that free cash flow is spent on stock buybacks. So whenever I see that, I like to go and check out the share count and see, okay, are they actually reducing the share count with that? The answer for most tech companies, as you can guess, is no, they're just soaking up dilution. And therefore that the money they're putting towards stock buybacks, you might want to consider that employee pay rather than a stock buyback helping the shareholder. But that is not the case here at Academy Sports. All that buyback money, it looks like we had share count as high as 83, 84 million. Now we're down to 74 million. That's fully diluted shares, and sometimes that is also affected by the price of the company itself. However, that looks okay. Not knowing the stores that well, it's hard for me to have more of an opinion than that. I will note that I went through the Dick's Sporting Goods results the other day, and they seemed okay, but like okay these days for a big retailer like that is like 5% top line growth, maybe 6-7% comps or something. Or that would be huge. And Dick's is doing okay. But Academy Sports, kind of a smaller competitor, I'd be interested enough to take a deeper look personally, having seen what I saw on that sheet. But this is a low growth kind of business opportunity, any kind of sports retailer in general. And so you need to be pretty sure that either the market is missing something, that there's a turnaround on the way that nobody else can see, but you and your colleagues buying the stock do, or that just everybody has fundamentally mispriced it, which can happen in a recession, right? People can absolutely freak out and throw all of these stocks in the toilet. But I would definitely need to see a little bit more, even though it's trading at what looks like a pretty good free cash flow yield, especially compared to a lot of stocks out there these days.
Yeah, I'm looking at it here, and you were saying low growth. I think low growth would actually be a little bit of a reprieve lately.
For them,
I'm looking at
yeah.
it, and it's since fiscal year 2022, we've seen a decline in sales year over year. So that's
I was talking about the industry in general as kind of low growth.
Yeah, so I probably there's a reason why it's trading at 7 times earnings right now.
Yeah, there usually is. What's weird though is we're just talking about like shoe companies and some of the other sportswear. And again, I don't know which brands Academy sells, but Dick sells sort of all the major brands. And so it's interesting that on one hand, we can be talking about like, oh, which is the hot new shoe company that's going to be growing at 30-40%, right? And then on the other hand, the overall market is just barely creeping up, which indicates that to some extent, this is a little bit of a zero-sum game, that somebody else's gains are coming at the loss of business for another. manufacturer. And, we definitely could probably posit that for Nike, right? Maybe even for Adidas in some ways. So these are rough businesses to invest in. I used to kind of look at them a lot more and invest in them a little more often. And I kind of started getting away from that over the past, well, actually, I guess started doing that kind of around COVID, even after they got clobbered. I picked a few of them up when they were cheap. And then some of them had just never worked out. Some of the outdoor goods, sporting goods companies. So I've been burned a couple of times, and I tend not to look for those stories so much anymore. If something's got flattish growth and I don't see a real catalyst for that to change, the valuation almost doesn't matter anymore, unless it's so out of whack that I'm getting the store base for free or something.
All right, so this is a slightly unrelated question because I'm on the Academy Sports and Outdoors website right now, and their banner sale right now is 25% off Stanley coolers. Now, I have to ask, as somebody who hasn't lived in the States for like close to 9 years now, what the heck are these Stanley coolers, and why does everybody want them so much?
The giant cup, is that the one you're talking about? Yeah, that became a thing. I have a hard time figuring out. Nobody in my house has one. But this is the kind of house where we recycle like garbage into useful things. And my daughter carries around a cheap Amazon water bottle that she named Strondar, and she's proud that it cost $11 and not $48. So I'm a bad person to ask about that kind of stuff.
Okay, I'd say, I find myself so far behind the curve of like niche products and things like that have become wildly popular in the US, and I just look around like, I have no idea what this is. And I would see like social media stuff on Stanley coolers, like, what the heck is going on here? People lost their minds.
Yeah, and you saw a whole lot of them. A lot of them were up at front of Dick's too. And these things are enormous. And part of it, of course, is the idea that that you have to drink 8 quarts of water a day or something that we somehow have. So people are constantly hydrating. And that might be part of it. There's a question here from Sadaf about ASML's decision to open a facility in Beijing. And yeah, they do a lot of business in China. And so that has been a risk to that investment thesis, especially because, as we know, the last administration was among those saying, like, you can't send the machines that can do the best stuff. And so, as far as I know, that facility they're opening in China is designed to kind of repair and remanufacture stuff that's already there. That seems to make some sense to me, and it's probably a way for them to more easily get some revenue. ASML does a decent amount of revenue in like maintenance and other things. They have to. If you look at these machines that are delivered in crates and put together, and they take up, what is it, a 747 or 2 to get them there, and they're so complex. You can tell that once they're together, you can't just like press the button and then they're working. I mean, these are really complex machines. So that makes some sense to me. I guess I don't really have a concern about that so much. I mean, to me, the risk is the same. It's a little bit of political whim or political theater. And so you don't know how that's going to play out. And I think you know even less now than you did maybe a year ago. So you just have to say that there's a section of ASML that is unknown risks that I will never be able to quantify, and adjust the price you are willing to pay accordingly.
So Besties asked about 13 minutes ago. I can hit this one. Well, Seth looks up his next one here. Besties is asking, what would you consider EPR, the ticker EPR, which is also the name EPR Properties, a good buy now? I know that I think there's some other people that I talk with a lot. I know Matt Frankel's a big fan of EPR Properties. There's certainly some aspects about it that would look attractive to some people. I mean, it has a 6.92% dividend yield right now, and this is a real estate investment trust that focuses mostly on experiential properties. About a third of it right now is related to movie theaters, with ski resorts, some Top Golf, whatever we want to call a Top Golf facility or whatever. They've made some acquisitions into there, bowling, basically anything that involves entertainment properties. They tend to they tend to invest in and be the landlord for these properties. There's a couple things, and not just from the price perspective being a good buy now, but that I've been a little hesitant as of late to watch, because obviously during COVID, the theater was a major problem. Regal Cinemas was one of its major tenants. They went through a bankruptcy, and so there's the cinema movie theater component of its portfolio is still very much in like repair mode. They're trying to get back to the same. They rewrote some leases to be a little bit more forgiving for these operators who were struggling, and they've been trying to de-emphasize its movie theater portfolio. It's also trying to de-emphasize some properties that not only did they own, but they were also the operator of. They were mostly hotels in Florida, some of which I think one of them might actually have been totaled because of one of the recent hurricanes, and they've been looking at insurance recoveries and things like that. Another part of the business that they've been de-emphasizing. And also they have a small portfolio of private education properties, preschool, private charter schools, things like that. Another component where they say they're de-emphasizing. And so if you look across a portfolio, there's a lot of de-emphasis right now. It kind of signals that this thing, they're doing a lot of portfolio turnover. There's not necessarily growth, if you will, because, as much as you want to try to buy ski resorts and you try to, get more Top Golfs, or I think it was also something similar to a Top Golf. It's like a Mario Andretti racing experience. Same idea. It's like a Top Golf, but for driving go-karts. There's only so many of those you can do to offset all the other things that you're de-emphasizing. And as a result, you get this portfolio churn that doesn't lead to a lot of growth. And at the same time, this is a business that, even by REIT standards, has carried a relatively high amount of debt. Obviously, what do I want to say here? Obviously, when it comes to real estate investment trusts, you're always going to have leverage relative to the industry. But this one for a while was carrying quite a bit. In 2022, it was like 6 times EBITDA for its total debt load, which for a company that's not growing much, that's not great, especially when you start to think of higher interest rates bringing up their cost of interest that they have to refinance. I mean, you don't get a 30-year mortgage in the commercial real estate space. You get 5 to 10-year mortgages that you need to turn over frequently, which changes your interest rate results. So there's part of me that just says, I don't think it's going like bust. I think it's okay, but I don't know how much like upside is in it either, aside from its 7% dividend yield. I think this is just kind of one of those, it's going to muddle through, but I can't really see it as like a, oh yeah, this thing is going to grow, it's going to do fantastic. I think it's going to be a little bit of a frustrating endeavor for a lot of investors, and you'll probably keep squinting, be like, well, there's some improvements, it's going to get better, right? Well, I think it's just going to take a lot longer than people think for this thing to, execute that entire portfolio turnover.
Yeah. Oh, what do we got here? Sadaf asks, how do you rank Google, Microsoft, Amazon? Again, this is like apples, oranges, or what did they say last hour? Apples and catfish, did Jayson say? These are 3 pretty different businesses from one another, except that they are all, very good at doing the tech, but they use it for very different reasons. So Google, does a lot of very interesting things, but Google is an advertising company. First and foremost, that every bit of tech that they've ever invented has been in order to like sell and optimize the sale of ads. They started out as search. Does anyone remember that? Maybe not. The ads are the first thing you see when you search now, but they started out as a search company, and now it's an ad company. And they just dominate that space. So on a valuation basis, these 3 to me all look fairly similar. Amazon may be the priciest, which is ironic in a way, because a lot of its business is super low margin retailing. But that's the way it is. Google is probably conceptually would have the most to lose if any of the LLM search outfits out there were really able to take market share or change the way search works enough of a way to hurt their business. But I always thought that was a low probability event because it's just sort of everywhere and people just use it. And anything that anybody else was doing with LLM search, I thought like Google can do the same thing. In fact, Google had overviews before everybody else did overviews. So I don't think any of those are competitive advantages that the smaller companies have that Google couldn't equal or surpass. Microsoft is a very kind of diverse book of business that I think is in a lot of ways stronger because it's selling to a lot of enterprises, has long, deep relationships with them, helps them do more, be more productive, and is renting a ton of cloud AI capacity right now, as is Google and as is Amazon. So all three are racing that way. So it's hard for me to rank them. I guess I'd say I like Microsoft, then Google, then Amazon the best. And some of it depends on what you think of the management as well. To me, I don't know if you need to rank them. If you believe in this maximalist AI future, you probably want to own all of them. The prices have recently gotten a little better. And if you don't believe in that future, you might want to wait around and see what's going to happen. Thoughts?
I really have to punt. I know I'm probably like one of the 5 people that looks at companies and has zero thoughts on Mag 7 companies because I don't know. I don't spend much time with them because there's so many other things to look at.
Yeah.
So I'm just gonna punt.
It does get a little boring to just look at them. Yeah.
Yeah, I'll do the Charlie Munger and say I have nothing else to add. Besties, this is a really challenging one, and I think I'm going to have to say probably not. But Besties ask, any good businesses that are investable in your part of the world? Well, I currently live in Tbilisi, Republic of Georgia. There is it's very, very small. There's a publicly traded market here, the Georgian Stock Exchange, but it's actually just I don't think they have any publicly listed stocks. It's all debt. And the biggest companies here are actually traded in the London exchange. So I don't know. I haven't dug into anything enough to say explicitly. So I'll shift quickly because I saw Bessie's asked another question about EQT. This is EQT Corp, the natural gas driller. The question is, Tyler, EQT or any that are benefiting from the drill baby drill theme. I'm not too big on the drill baby drill theme. I think that story played out in the 2010s, and I don't think that there's a lot of oil and gas producers and management teams at producers that actually ascribe to this drill baby drill theme. I know it's a political kind of topic of unleashing American energy, if you will, but we saw what happens when you drill baby drill in like 2014, 2015. We all thought that shale was going to be this monster revolution, and it was. Like technologically, it disrupted the market. We went from a country that was down to like 5 million barrels per day to I think if
world
you
leaders.
include things like, huh? What was that?
We're the world leaders now, are we not?
Yeah, I think if you count like some of the natural gas liquids sort of things as oil, we're at like 20 million barrels per day now. So yeah, we went from barely hanging on, importing a ton to the largest producer in the world. And so which is it has its benefits. I mean, certainly oil and gas especially gas is a lot cheaper in the United States than it was pre-shale, but there was exploration production companies that got absolutely wiped out by this. They just thought they could drill and just the wildcatter mentality always is like, oh, I can drill my way out of a problem, and just kept drilling, kept taking on debt, and it was unprofitable because of just the mechanics of how shale was working. Shale's gotten better. The cost per well or the cost per lateral length has gone way, way down. They've figured out to wring out a whole bunch of costs and efficiency, and it's almost become like an assembly line in like South Texas and North Dakota and things like that, where it's much more effective. And so And I don't see a lot of management teams like clamoring to drill when we have oil prices in the $65 to $75 range. Like, that's nice and they can make a profit, but nobody's like clamoring to expand their production at that level. They're like, we can be pretty fat and happy just maintaining our current production. As far as EQT specifically, this is where, and I might be unorthodox or a little counter to some recommendations that happen at some of the Motley Fool services and things like that. I know a lot of people are very bullish on this, but as a company that only drills for natural gas, I think that's a really challenging proposition in the United States, because a few years ago we we did a really good job of getting rid of flaring. If you remember the topic of flaring, where we were just, companies that were drilling for oil would just take the natural gas that was coming associated with those wells and they would just burn it right on the site. And as we cracked down on flaring, basically everyone started to either, connect a pipe so they could sell it, or they found ways to use it to power on site. And as a result, like the amount of gas that's going into the system from like these, we'll call it associated gas, has been huge. The Permian Basin, kind of the premier oil basin in the United States, has been, 5-6 years ago, it was like 2 units of gas to every one of oil. But today it's like 3, based on like the changing geology of where they're drilling and things like that. So there's a lot more gas coming to the market that oil producers barely care about. Like there's been points where like the assembly point, it's called the Waha hub. It's very similar to like, we call it like WTI spot prices. The Waha hub is one of the like known gas hubs. For like much of 2024's winter, Waha hub prices were negative. Like producers had to pay somebody to take it away and use it, because they had no other way to do it. And if you're only producing gas like EQT does up in the Marcellus Basin, and you don't have an oil profile, you're kind of subject to this large component of gas production in the United States that is completely agnostic to price. Like nobody in the oil patch is making this capital allocation decisions based on natural gas. And so with that, it's going to be really, really hard, I think, for a company like EQT to be hyper competitive. I mean, they'll be able to take price when they can and use things like futures contracts to make sure that they're not selling unprofitable gas. But I struggle to see a point where like we're going to get these large spikes in gas prices that could lead to monumental cash flows or things like that for EQT. I think there's just going to be this kind of like the ceiling on gas prices that will, they'll be able to get along fine, but maybe not the hyper productive cash flowing gas generative business that some people might purport to be, especially with like, more LNG coming online.
Yeah, it's hard for me to imagine anybody repeating the mistakes of the aughts and teens where they drilled themselves into $30 barrels. I mean, it is a political statement, and it's based on a falsehood, which is that there's some massive conspiracy of some kind holding back like oil or gas production in the US. It's clearly not the case. I mean, we're at record levels, like you said, and the companies aren't going to try to drill themselves into unprofitability. That kind of momentum is gone, which makes sense.
I have a slight, it's not necessarily political, but it's a little like off. But I think there's like a secretly, they all kind of don't mind it when, they have a little bit more regulation and resistance from political environment, because then they get somebody else to blame when,
exactly.
Things go sideways.
Yeah.
They get higher prices because they're more regulated, and then they get to blame like, they let us do this, we would, drill way more and everything would be great. But then when the chain comes off, they don't do anything. And if they do, they end up shooting themselves in the foot and tank oil prices. So I don't know. It's just a casual observation I've had over the years where, whenever they do seem to get exactly what they want, they don't do it.
Yeah. It also is interesting, the remarks about more flared or formerly flared gas being collected and sent off. It would be like, if I were a business person, I would be super nervous if my product was a bunch of other people's byproduct.
Yeah, that's the thing that scares me the most about anybody who only produces natural gas. It's like, you got to find some liquids or some oil somewhere that other people are making capital allocation decisions on, and not just a byproduct.
Yeah. Let's look at our questions while we've got about 8-9 minutes left here. We had AIS. Well, let me just get rid of Besties near Lake Superior. Yeah, Besties way north of there, even up on the Iron Range in northern Minnesota. I grew up in a town called Virginia. Everybody who's interested in what mining can do to a landscape, go to Google Maps, hit the satellite view, and look up Virginia, Minnesota, or Hibbing, Minnesota, where Bob Dylan is from. Peter asks, what is a good PE ratio for Nvidia to buy and sell? Well, that's the kind of question I would at first be like, I can't answer that question, and I can't answer it at that point. But so I'm going to redirect it to how do you figure out when you want to buy or sell a company like this? And it's a really difficult question, especially with a company like Nvidia, which is already like one of the largest companies in the world and remains so, even though the stock is down a good 20% from a few weeks ago. And so you don't want to look at a PE ratio or an EV and to revenues, price to sales ratio on something that's growing as quickly as Nvidia is, because you're going to get lost. You also don't want to use like the PEG, the PE to growth thing, because the forward growth is very difficult to predict. It is really tough to figure anything out. And so one of the things I do is I try to model the free cash flow growth. Now, over the long run, that should matter for the valuation of the company. But when a stock, even if it's got great financials, has become kind of a meme stock or a poster child stock, the free cash flow expectations probably don't matter. It's more animal spirits. And the issue I have had with Nvidia is, like, no matter what kind of a model I produced, and even if I put like a really seriously crazy looking growth predictions on it, it still looked like it would have a hard time living up to that. And it's mostly because we're not talking about some little company where you say, well, they can't continue to grow the top line at 30, 40, 50, 60% a year for 8-9 years, can they? A small company could potentially, right? It'd be pretty huge by the end, but a small company could. But Nvidia is not really a small company, and it's selling, its revenues are only in the hundreds of billions right now. But very quickly, if you try to extend out these models to the point where the price looks like it makes sense, you start to see sales figures that start to rival large portions of world GDP. And so the law of large numbers makes this kind of thing hard to figure out. So that is my long way of dancing around the question of saying, with Nvidia, I try to look at what I think are reasonable growth expectations regarding like what I expect of free cash flow. But even then, like, it's really tough to figure out what could happen, even if you think what'll happen with revenues. For instance, Nvidia's gross margins are insane right now. They're 75% for like a company selling silicon, selling hardware. 75% gross margins is nuts. Free cash flow margins, in 46% range. That's also just crazy for hardware makers. You say to yourself, at some point that has to shift, because it always has in the past. We haven't seen it yet. I could have said the same thing 3 years ago and would have been wrong every time. So it's really not possible to answer that question. I will say right now, I don't look at Nvidia and see it as super overvalued. And I was doing the Rodney Dangerfield with my collar a little bit more back when it was $150 a share.
I don't have any hard thoughts on Nvidia especially, but there was one little touch point that I can't get away from, because you mentioned PEG ratio and the price to earnings growth ratio. And this is, I guess, one of my like pet peeves, because, you said not a whole lot of credence to it. I give it zero credence, in large part because, like, I as like a long-term investor, and I would say like 15, 20 years of kind of like the foolish clownery that we've had of, I wouldn't say like mocking Wall Street analysts, but being like, is that really what you're doing, and you look at Wall Street analysts and they analysis and growth projections, and they tend to change pretty quickly from a quarter to quarter basis. And if you know this in advance, you know that the PEG ratio is based on earnings estimates developed by Wall Street analysts. And so you're kind of basing it on this consensus thought of what people are looking into their crystal ball. And to me, that's like, it makes it kind of useless, because it's not like a hard number. It's basically like, we're going to take the price and the earnings growth, and then we're going to, like, use some crystal ball number that Wall Street analysts have used, and that'll give us an explanation of why it's undervalued or overvalued. I'm like, well, we all kind of say, like, we don't believe the growth projections anyway, so why are we doing this?
Yeah, so over a year, they might be fairly close, right? Because a lot of companies do a very good job of holding the analysts' hands, either during the call or after the call, so that they know which numbers to plug into their Excel sheet, so that the company gets the earnings estimates that it wants, because it wants them here so that they can do this and just barely, right? So managing the estimates is part of the job that companies do. And so over a year, it might kind of be sort of more accurate, but in the end, yeah, it's tough. And it's also sort of picking a PE ratio is very difficult. So if you have a company that's been around a long time and the margin structure has been relatively stable, right, then you can kind of look back and say, all right, well, over the years, people tend to pay this many times earnings, if they're operating as they usually do, right? In a time when margins are ramping up, so they're getting leverage, all of that stuff flies out the window, right? Just like it all flies out the window if they start to deleverage on the way down. And so all of these are all really rough tools. That doesn't mean they're useless. It just means they all need to be used within the correct context. I will throw out shorthands about like free cash flow yield and stuff all the time, but I'm always looking at it in the bigger context. Like, if a company is trading at a low or it looks like a really expensive free cash flow yield, the first thing I look at is, okay, is the growth, and is there growth in margins that's going to make this, is going to make this number obsolete in the very near future. So dig into the numbers and take a look at this stuff and try and make up your mind for yourself, and look at old boring companies too, to see what has happened. Like oftentimes somebody will say, what do you think of X company? And I'll look at it and I'll see that the stock has been on a tear, but literally the revenue is flat, the margins are flat. And so the only thing that has changed is enthusiasm. For some reason, everyone's willing to pay 28 times earnings. But, for the 10 years before that, they were only willing to pay 19 times earnings. That's an investment that makes me nervous.
Yeah. And actually, this is a good follow-up, because I'm on for the next hour. So I'll leave this one to let you finish with, because Bestie asked, Seth, how would you describe yourself as an investor? What types of things do you like and looking for? You kind of touched on it a little bit there, but maybe just adding a little bit more color on the way out.
Yeah. So stories that make sense. I tend to try to buy things when the financials look okay. I will take some flyers on things like Rocket Lab and others, just because they're fun once in a while, small amounts of money. I guess I try to look towards growth at a reasonable price and value when I can get it. I will kind of go wherever the idea is. I tend to try to avoid really complex investment scenarios. So if something is like a turnaround that depends on a bunch of things happening, and maybe one operator doing a great job, I tend to avoid those kinds of stories. I'm also not big on stories that are super personality dependent. I'm not one of those people who's like a CEO cheerleader. There are very few CEOs that I have a lot of respect for, and then there's a whole bunch that I'm kind of like, they're okay, they're doing no harm, and they're doing their jobs. And then there are a whole lot, even at companies, where I think the company's okay, and I read the conference call and I wish I could unread it and not remember what the CEOs say, because they come across as con men to me when I read them, and then I start to get nervous. I'm like, no, you had a good quarter. Why did you have to say all that stuff that sounded really kind of sleazy and weird? So that's the kind of investor I am. Suspicious, try to be hopeful, and try to find stories that make sense. and that's it.
Well, with that, I think that brings us to the top of the hour, and that means we're going to be moving on to our next, and we're going to say goodbye to Seth, and Jayson Hall's going to be joining me here in a moment. I see in the comments that Jayson Hall is saying that your description is very much a Peter Lynchian.
It is a little bit.
Approach.
I think the quote, or if I have it wrong, we'll call it apocryphal, whatever it is it was something along the lines of pick companies that like even a monkey could manage, because sooner or later one will be in charge. Like sooner or later, the company's going to have somebody not great in charge of it. So you should pick a company that can kind of keep going no matter who's up there in the C-suite.
Yeah.
Any idiot, Jayson says, hey, that means I could be a CEO. Yes. I'm going to go have AI write me a
hopefully
right now.
That is the case.
And with that, I'm doubly qualified. Seth, if you qualify based on that metric, then I'm twice as qualified as you.
Excellent. So yeah,
enjoy the rest of your day. Hey, Tyler.
Thanks, Seth. Hey, Jayson. We're doing it again.
We are. We're talking about stocks that are down. We're going to fish in the energy industry. We're going to talk about energy stocks that we like, but there's other questions in here too about other stuff. We can talk about other stuff too. So get those questions into us, slido.com. The event code is Fool24, all one word, just Fool24. Get those questions into us, Motley Fool members. It's awesome to see you. YouTubers that are watching on the YouTube stream, it's awesome to see you too. You get a chance to peek inside some of the things that the Motley Fool provides for its members. So it's good to have you here. Tyler, I want to make sure and remind everybody too, send us your questions, but when we answer your questions, please remember and note, we are not giving you individual advice or direction, no personalized advice. We do not provide personalized advice. This is for education, educational purposes only. We know a bunch, but we don't know you or your situation. You don't want us telling you individually what to do, but maybe it can be useful information that you can factor into your decisions. All right, Tyler, where do we want to start here?
Well, we did have the it's energy stocks we like, but also energy stocks we like that are down a lot, because there has been quite a bit of down energy lately. We did a stat yesterday on industrial stocks that were down 10% so far this year. And I think it was like 220 or so, because industrials is a pretty diverse group. When we go this for energy, and although this one is kind of hard to lump, because when you look at like the sector or industry classifications, you don't have things like solar or wind power often in them, because they are industrials or semiconductor categorized as those. So when we talk about energy, it's mostly oil, gas, and coal. And so of those companies, like I said, 223 industrials down 10% yesterday. Today, I did that same screen just using energy. We have about 99 companies that are down 10% or more so far in this calendar year 2025. A lot fewer, but then again, the energy sector is considerably smaller.
I'm going to share on the screen some of the SPDR ETFs, the SPDR ETFs. I just sent that over, Adam, if you can share it. So these are ETFs that can give you, again, we have, well, let me take, I don't know why that was on there. Was it XLR, I believe? No, what's the oil and gas? It's the energy. Sorry, fools. I should have
Energy Select.
XLE. Okay. Yeah. XLE. That makes sense. So that's this one. So this chart is set for percentage off the high. So it's down about 10.5%. This is the S&P 500 member companies that are in the energy industry, the energy sector. So like Tyler said, oil and gas producers, integrated oil and gas majors, pipeline companies, refiners, the services and equipment companies in that space as well. That's all of them. It's down about 10.5%. Now, this has been ballasted a little bit by some of the largest companies that have held up better, the integrated majors and things that kind of hold up a little better in these sorts of environments. And then you have the oil and gas exploration and production companies down more than 26%. And the oil and gas equipment and services companies down nearly a third against the backdrop. And this is gonna shorten up this chart a little bit because I'm going a little bit far back for oil prices. But you see, even in the so this is a little bit better. You see Brent crude down about 23% over the past year. So this is from the highs. So again, the entire industry ballasted by the largest cap companies, oil prices, and then the companies that are a little more targeted and specialized in what they do. Tyler, would you like to talk briefly about why those particular subsectors, their stocks are down a little bit more, and then tie that into oil prices?
Sorry, you were saying producers versus like the
refiners?
refiners?
E&Ps and equipment services.
Well, I mean, equipment and services is just we've kind of used a shorthand before when we talk about exploration production companies where they are levered bets on oil prices, right? Especially in the short run, because there is no premium pricing in oil. There's some, we'll call them like arbitrage opportunities, but nothing so huge that is going to, nobody is the Ferrari of oil out there relative to anyone else. They're all price takers. So as a result, like everybody is just going to move up and down with the price of oil. Some of them might fare better than others because if they have lower cost production, efficiency, whatever, capital management, they might be better capital managers.
Adam, I just sent over another screen share if you can release it that displays exactly what Tyler's talking about. So the purple, this is oil prices. Brent crude is that global standard, and then the school bus yellow orange, that's the exploration and production ETF. So the companies, that's all they do. They don't have any of the other businesses to provide ballast or countercyclical cash flows. Yep. And you can see it's definitely singing a verse from the same song here, right? A lot of correlation.
Yeah. And then when it comes to counter that with the other components of the oil and gas industry, obviously integrated managers, they have refining, they have downstream assets, which tend to be countercyclical. They tend to do well in a declining oil price environment. So higher margins, things like that. Retail tends to be very steady eddy. And then as the services industry, it's just like a weird, unique beast. And this has been one that's really been challenged over the past 10 years because for so long, with the services industry is very much like the capacity to do things. And post 2015, when oil prices fell through the floor, there was way too much capacity for there was too much equipment, there were too many rig crews, there was too many drill ships, there was just there was too many things available to deploy assets, and as a result, all these companies basically had to, shrink down. They had to, retire rigs. They needed to, send ships to the scrapyard. Basically, it was so bad. It was you'd have companies that built a ship 7 years ago, and these things are supposed to last for 15, 20 years. And it'd be like a 7-year-old ship, and it would immediately go to the scrapyard because they were over capacity. There was too much capacity in the industry, and so the industry itself, like it's gone down a little bit because it does. The market tends to react to oil prices, but I would say that the services industry, at least compared to what it was several years ago, it's in a better place. Yeah. Like it's a little bit more balanced with supply and demand of what's going to go through. And so they can start to push price a little bit on producers because producers basically take all those services and equipment companies and contract all the work out. So there's a little bit of pricing there maybe, but in this very steady state sort of industry right now, where most companies in the exploration production business aren't like chomping at the bit to grow their production right now. It's just like it's maintenance stasis mode. You don't need a whole lot of equipment. It's enough to keep these companies going, but not enough that they're going to be making investments that they can push price to, grow margins or anything like that. It's just kind of, it's very much in a holding period. And even they don't necessarily, like, their business prospects may not necessarily correlate with oil prices, but their stock prices do, because everyone looks at the producers and be like, well, if their stocks are going down because of oil prices, they're not going to use services. So it's one of those like correlated to oil by default.
Yeah, and again, that's in the near term. All of these companies to some greater or lesser degree correlate with oil prices. in short periods of time. But over the long term, the interesting things over the very longest term, Tyler, this is an industry that did create a lot of alpha, a lot of market outperformance and strong returns. But the past 15 years has been more challenging as we've seen the emergence of shale have changed some of the dynamics. There was a lot of capital, lack of capital discipline for the first half of the 2010s.
That's putting it lightly.
That's putting it lightly, yeah. But the reality is, if you look at that equipment and services index, that ETF, that subsector, it's down 70, almost 75% from where the prices were 10 years ago, and it's down more than that if you go back 11 or 12 years ago, because so much money flooded into exploration and production to chase shale, that the services companies, they levered up and they invested tons of capex in acquiring equipment, growing their rig fleets, and all of the various pieces of equipment that were used to, which a lot of them, they were new. They needed to bring these new assets out there if the demand was going to be there. And the industry has changed enormously. And the biggest thing is the capital discipline that we've seen from these pure play exploration and production companies over the past, really starting in like 2017, 2018, is really when they had to get hardcore about it. And that saved a lot of them during the pandemic, when oil prices gutted so much. Yeah, and what we did see is the ones that were still the marginal producers got washed out during the pandemic because nobody was going to lend the money. And the emergence of today is just a more capital disciplined industry. Even going through the lows of the interest rate environment, 2021, we didn't see these companies go after cheap debt. They didn't necessarily have access to a lot of it because the lenders, banks in general, were very reticent to lend to them during that period. And it's instilled a new sense of capital discipline that could lead to a few winners over the long term. I'm still really reticent to recommend any of these E&P, pure play E&Ps to be long-term winners, because it is a tough industry and there's so much churn, because so many of the pure plays are focused on shale, where you just have to turn the rigs over and over and over because the decline curve is so steep from those assets that just to maintain capacity, you have to constantly be drilling and finding new resources to develop. And that's a tough environment. They're on the hamster wheel, so to speak. But there can be opportunities. So let's move beyond that, kind of those mechanics of go ahead.
Well, we can parlay into a question here because we did get a question about the ETFs related to energy. Because Rose asked 9 minutes ago, how will AMLP, which is the Alerian MLP Index ETF, and XOP, which is the oil and gas producers ETF, how will they fare in the near term, 5 years out, 10? I think we can both punt on the near term future because it's commodities and commodities can do anything in the near term. But I think we can.
You're talking to two guys in between them. We're talking 35 years of studying the oil and gas industry, and we're punting. It's a reminder that the people you see on TV that are making predictions, they might know more, but that doesn't necessarily mean it translates to any more accuracy or precision with predictions in the near term.
Yeah. I mean, it's not the current CEO of Total Energies. It was the previous one, passed away in a plane crash, tragically, but I can't remember his name. It's leaving me now, but somebody actually asked him in an interview, they're like, where do you see oil prices going over the next year? And he goes, up and down. And that's what this industry is. Like you can't really, it's so hard to predict, especially in the short term, because there's so many factors. This is a global product, and you can have it could be something like an outage at one of the export terminals in Nigeria, and things that you have no idea about that are going to fundamentally shape the oil and gas industry over the short term that you just can't predict. And so trying to do that is impossible. 5 to 10 years out, I think we can start to maybe talk about these two a little bit. And I'm going to be partial to the Alerian MLP ETF, which is a MLP. MLPs, or Master Limited Partnerships, are a special type of entity that typically resides in the oil and gas infrastructure space. So this is pipelines, this is storage, this is trucks, basically any sort of logistics that's going to move product from a wellhead to a refinery, or a manufacturer or an export market. Take your pick. They have assets all up and down this, including even some like basic, I wouldn't say refining, but like chemical separation and things like that. In my opinion, I think this business in the 5 to 10 year period is a much more predictable and stable entity, because when you're talking about infrastructure, you're not talking about prices, you're talking about volume. You're talking about total demand and use.
Yeah.
Most of the companies in the MLP index, there's not many anymore. The MLP, the Master Limited Partnership structure is going the way of the dinosaur, really. But those that are remaining, they don't typically take price. They don't take price when they're doing infrastructure deals. They do what are called like take or pay contracts, where it's like, you're going to pay a fee to move on our pipeline.
Yep.
Whether or not you use that pipeline or not, we don't care. You're going to pay for it. And it's typically going to be like a 20-year deal. And so when you have things like that, you have extremely predictable revenues and very stable cash flows, very stable revenues. So what you can get with these companies is large dividends that typically can be supported for long periods with, modest growth. Not great right now, but there will be, I would say, like small amounts of growth in the future. And as long as like the businesses that are good operators and can manage their debt, manage their growth profile without doing something silly like a building out a piece of infrastructure that's below their cost of capital, they'll do really well. I think the two largest in the Alerian MLP index are MPLX, ticker and name are the same, and Enterprise Products Partners, which is EPD, both of which I already own in my portfolio. And I think there's some of
Plains
the
All
best
Americans in
operators in
there
it.
too, in their top three. So
So
yeah, no,
all
I
in all,
think,
like just good operators.
yeah, no, that's the key. So yeah, so I'll let me kind of take the other side of the coin on that a little bit. I agree that if you're looking for that 5 to 10 year period, I would not suggest XOP again, because that's a pretty long time horizon for independent oil and gas producers. That specific line of work, I would put it definitely in the too hard pile to be thinking 5 to 10 years on. I'll explain why in just a minute, but I wanted to circle back to AMLP, that particular product. Here's the headwind of investing in AMLP. The expense ratio is almost 1%. That is a lot of headwind for an investment that most of your return is going to be built on the dividend yield. You're giving 15% or 20%. I haven't looked at the yield of that product, but thinking about the 5+% yields of a lot of those MLPs, you're giving a ton of your yield back to the manager of the fund in the expense ratio. I would suggest
I can explain why. And
the reason why is because of the tax implications, because they're MLPs. Right.
Yep.
So there's a reason for that.
Yep. So the ETF pays the taxes and you get a corporate dividend,
right?
Which is, just basically what you can own in most any other entity, brokerage, retirement account, whatever.
Right,
versus Master Limited Partnerships, it's a very unique tax structure. And so that management fee is really high, but that's by design because they're paying, partnership level taxes for you. And
I wanted to build on that, because that's part of like the upside. So for investors who are looking to own these in a taxable brokerage, especially with zero trading fees and with the ability to buy fractional shares, let's say you wanted to invest a couple $1,000s over a year, dollar cost average, into this sort of thing. With modern brokerages and those mechanisms, if you're buying in a taxable account, what I would do is I would by the top 10 operators in these MLPs, by the 10 largest, just 10% in each of them. And I would build it out that way. That's the way I would do it. You can't do that inside of 401k, rollover IRA, or Roth, because once you start hitting certain thresholds, there's a risk of UBTI, which is unrelated business taxable income, which a lot of these MLPs generate. And you could actually create a taxable event inside your retirement account as these compound and as the size of the investment grows over time. So an easy way to avoid that is buying the AMLP.
Yeah, the ETF. So
AMLP, because it's a corporation. You're investing in the corporation. It's a corporate dividend. Takes that completely off the table.
I know everyone loves talking about corporate dividends versus partnership taxes and all that stuff. It's wonderful, engaging conversation. But for people who are Fool members, as Zach's a Fool mentions in the Slido, buying MLPs not via ETFs, there is a community message board for paying members that talks about this with some people who are decidedly more versed in the tax implications of this in the community board. So I would invite anybody who's a Fool to go check that out there. And people who are viewing this from YouTube, one of the things that you get as a paid member for Motley Fool services. So just a nice little shameless plug there as we go along. We'll continue this thread, and we'll get onto some other ones in a second here. But Vihan asks about me, MPLX EPD. Yes, are they better suited in taxable account? In my opinion, yes. For a lot of the reasons Jayson just said. Yep. And again, I would check out the community member thread because it's a little bit. There's definitely more to be said about this before we cover that. And Zach's a Fool also mentioned it as well. So I think we can. I think we can move on. I have one more without getting too deep into the weeds.
Yeah, we can move on from taxes. I do want to talk briefly about XOP. Right? Is that the?
Sure. Yep.
That's the E&P one. Here's the only time that ever gets really interesting to me. Is when we go through a period where oil prices are extremely low and the entire E&P sector is heavily discounted. It is an interesting, compelling way for, again, investors. I know the sector well. I know the risks, and I'm willing to take the risk. Sometimes the market gives you an opportunity to invest at an extremely discounted price, just based on some normalization of oil prices, in the near term, 6 months, a year, a couple of years, where you can find value and you can generate very strong returns because the sector is going through a little bit of a crisis moment and historically has always been able to emerge. And from that low point, there's an opportunity to make money. It does take a certain amount of discipline, and it's a little unfoolish because you're thinking almost in terms of making a trade where you're investing based on a super discounted price and you're not necessarily intending to hold for the long term, to be a long-term compounder, but you can generate a pretty decent amount of return. There have been opportunities to generate a decent amount of return in the short term, but again, as a compounder, I still struggle with that particular subsector. All right, let's move on.
So we got this is obviously energy, but a slight pivot away from oil. Let's go to coal because Craig Hollowell asked 20 minutes ago in a very loud all caps voice, talk about ticker BTU, please. So BTU is the ticker for Peabody Energy. Actually, one of the more clever tickers out there, really, because BTU is the measure of heat
British
energy.
thermal units. Yeah.
Yeah. So a fun little thing there. So Peabody Energy, I want to do my like Obi-Wan Kenobi. It's like, I haven't heard that name in a long time, but and for good reason, because this company's gone bankrupt twice in the past 10 years. So I do want to throw that out before we get too deep into it. So Peabody Energy, one of the largest coal production companies in the world, has US and also has Australian assets, has been really trying to focus a lot more on the metallurgical coal aspect of the industry relative to the thermal coal. Last hour with Seth Jayson, I was talking about the difference between metallurgical and thermal because people are asking about Alpha Metallurgical Resources and Warrior Met Coal. But basically, when it comes to metallurgical coal, you're very much a story tied to China, as I mentioned before, especially with Peabody having significant assets in Australia. The Australia coal mining industry has been a feeder for the Chinese steel industry for a very, very long time. And so with Peabody acquiring these assets, it's very much tied to Chinese steel demand and Chinese demand for metallurgical coal to do that. If you look at the financials for this business, the debt doesn't look bad. The cash flows and the margins are okay. Revenue growth has been very much a struggle recently because pricing. We had talked about previously, like the slowdown in construction and the real estate development market in China, obviously affecting steel because steel is a huge component of the construction market. So that has been a little bit of slowdown. If you were to squint hard enough, you can say, well, it from a balance sheet perspective, it looks good. From the margins, it looks okay. Yeah, it's going through a rough patch, but at 4 times earnings and 0.4 times book, there has to be some value here, right? And I don't know. It seems to me like this has been a story that we've been talking about for a really, really long time with Peabody, where it's like you just keep looking at it. It's like, well, we still use coal. It's still a prominent component of metallurgical or making steel. Thermal coal total consumption globally is still actually growing. So, why has this been such a struggle? And it's really hard for me to quantify. When it comes to thermal coal, which is most of its U.S. assets, a decent portion of its U.S. assets at least. The thing when you look at the long-term trajectory for coal in the United States, I know there's the talk of energy of all sources recently with the administration, which should be bullish for coal, whatever. But what I like to think about with coal and new electricity generating assets, it comes down to 2 things. It comes down to cost and time to deploy, because these are 2 very important components. It's one of the reasons we've been talking about nuclear and its biggest challenge is the time to deploy. It's a decade, right? Coal is one of the longer time to deploy things because you have to build steam boilers there and the facilities to support this, and to make a steam boiler economical, you have to have a very, very large facility. When it comes to time to deploy and cost, it's been very, very challenging to beat either a natural gas combined cycle turbine or solar. They're both very, very fast to deploy, and the economics on them are good enough. Am I going to sit around and wait for 3 to 4 years to get a coal plant up and running when I can probably have a gas plant up in 9 months or a solar installation up in 9 to 12? These are the considerations that utilities make when they're trying to do deployments, aside from the climate impact things that we're talking about when it comes to coal. So going back to Peabody specifically, yes, you can always squint hard and be like, there has to be value here. There has to be value here. But I feel like I've been following the story for 10 years, and every single time you squint, you're like, oh, it's getting better. It's getting better. Something rough really happens with this business, and it's had to go through multiple restructurings. And I don't know, maybe it's one of those no, does it work for other people? No, it never works, but it could work for us, sort of thing. And I don't know. Maybe I'm being a little too flippant here, but I struggle every single time I look at Peabody, despite its low price, despite all the things where you could be like, well, maybe, but ultimately, I just feel like there's better opportunities elsewhere.
Yeah, I think that's in a lot of ways, I keep putting it in the too hard pile because there's all of those moving parts that need to align in certain ways. There's this chance that it could just turn into a compounder by staying focused on where there is opportunity, not trying to grow, buying back shares, cleaning up the balance sheet. I mean, they emerged from bankruptcy with a pretty clean balance sheet, but yeah, same. I don't really have much more to add to that. So I want to step just briefly out of the energy lane and talk about Shopify. Ed asked about Shopify about 10 minutes into the show. So Shopify tickers, SHOP, asked, won't their margins be squeezed by tariffs? Stock could get slammed at earnings. Agree or not? So I'm going to just share on the screen here. Stock's already been slammed, and largely because of tariffs. The company reported earnings that were pretty okay, and the guidance was actually, the results were good. I'm not gonna say they're pretty okay; they were good. It was a little soft, but the stock actually largely went up on earnings after, a couple days after earnings. And what we've seen play out over the past month, give or take, past 3 weeks or so, this is tariffs. This is largely the impact of concerns about global trade, because where Shopify would be affected. So again, the platform, it's important to understand how Shopify makes money. So it makes money in two ways. It has its platform that merchants use, payments processing that it does, lots of services that it provides, and it earns money based on just the recurring revenue for the agreements that it has with its merchants for the platform. And then it gets a take rate of GMV, which is global merchandise volume, or maybe it's GMS, global merchandise sales, gross merchandise sales. It's the same thing. A percentage of sales that are processed through its payments platform that it gets a take rate for merchants that use its payment services. So there's the indirect economic impact that would affect the business if sales volumes with its merchants fall because of the impact of tariffs that creates friction for business across borders, or the economic impact of people having less discretionary spending and just buying less stuff. So there's that would potentially impact its business. More directly would be what it's selling directly to U.S. businesses across borders, right? The service that it's a Canadian domiciled business, and it does business with companies all over the world, but the U.S. is a really big market for it. So that base rate that it charges for services could potentially be impacted here. How much of that would the company eat versus passing along to its merchants remains to be seen. I think to a large degree, because there's been so much back and forth on tariffs. So it probably would. Again, the market's always forward looking. So the investors aren't just sitting around on their hands waiting for the company to say how it affected them. The market is already voting that it anticipates it's going to hurt the company's financial results. I think the business is really compelling at the price that it was at earnings. And now we're down a quarter from the pre-earnings or from the pre-sell-off peak. That I find the business just as compelling for what it can do over the next 5-10 years. There's still a tremendous addressable market for the business to continue to grow into. All right, shall we go back to energy land?
Well, actually, since we're paused on energy just for a minute, I wanted to hit a question from Besties that came in just as we were getting started. Besties asked, "Do you follow Jack Henry? Jack Henry and Associates?" Not at all a energy company. This is a banking and credit union software company. It's as boring as it sounds. Basically, there's dozens of companies in this industry that do this. They provide like a banking platform for doing things like payment processing and accessing to a bunch of other services. And Jack Henry and Associates tailors itself mostly to small, maybe even regional banks, and mostly credit unions. So not exactly the most, I would say, technologically advanced clientele either. And, for all the things that Jack Henry and Associates is, it's, the product that they have, it's a little clunky. It's definitely not what we would call like the bleeding edge of technology and payment processing or whatever, but it's relatively cheap. It has a very high level of customer service and support. And, for a small regional bank that probably isn't doing a lot of really sophisticated things like international wires and stuff like that, it can be very, very cost effective. And that's what has allowed Jack Henry and Associates to thrive in this industry, especially where it's a like I said, it's a brutal competitive knife fight of an industry, but also has a lot of consolidation, where there's even smaller companies than Jack Henry out there that do similar things, vertically integrated software. And Jack Henry has been one of like the more acquisitive companies, buying a lot of like bolt-on acquisitions and things like that, and has been able to do that relatively effectively and still get good returns on capital. This is a really slow growth industry. It faces a lot of challenges where mergers and things like that, they tend to lose clientele. And if banks get sufficiently large and need more complex tech stacks, they might go away from Jack Henry. So it kind of gets, burned on both ends with the shrinking base of small banks and regional and credit unions. And also when they do get bigger, they tend to graduate to more advanced features. That all being said, it's a business that still has been able to grow revenue through, services, pricing, things like that, adding functionality such that it can compete with some of the more advanced companies in the space. But that being said, it's not a company that is going to, I would say, like, not blow the doors off in terms of growth in the next several years, but at the same time is likely very resilient, unless we see like a huge, deposit runs where we see smaller regional banks all collapse and credit unions go away. Unlikely. I very, very unlikely, actually, in my opinion. I think they're going to have a relatively decent, chance of being resilient through the ups and downs of a recession or bear market or something like that. It's just one of those businesses that kind of lives in the background that nobody pays much attention to.
Which is usually where you can get margin. And when your customers absolutely rely on you to run their business, you kind of stick around. So
yeah,
let's take one more on the other side of the world here from energy. We're going to talk about a real estate investment trust in the healthcare business. We got a question from Matt P. Why is MPW, so that's Medical Properties Trust, ticker M as in Mary, PW, such a bum stock? Aren't there tailwinds with people needing hospitals and care? This is a perfect example of great industries that look like there's opportunity are not always industries that are investable. Tesla is the one example in the automaking industry. Maybe Toyota's
Ferrari
too. Ferrari's not in the auto industry. They're in the luxury goods industry. All right, let's be honest about Ferrari for a minute here. But the point is that Tesla's the lone exception over the past decade of an automaker that's really made investors a lot of money, right? It's a unicorn. Billions of dollars in investor capital has been destroyed by people trying to find the next Tesla. The unit economics for hospitals is brutal. And Medical Property Trust's biggest challenge is that its tenants are not good businesses. I'm making a blanket statement. Running hospitals is hard. It's expensive, highly regulated. You need specialized skilled labor that is always in demand and hard to find. Getting payments can be very, very challenging, and you have to serve people, right? You have somebody come into your ER, you have to treat them, and that costs money that you may not get. So all of those things, I'm not making any ethical statement about right or wrong about that, but a business statement is that makes it really, really difficult to make any money. And when your tenants are those sorts of businesses, it's very, very, very challenging. And that's the biggest reason I think that Medical Properties Trust has been a tough investment, is because it operates in a really, really, really tough space. I think they've also chased some opportunities and destroyed some value by not being great capital allocators. That's the short version. So just because you would think about all the tailwinds that you would think would be good for this sort of business that have been good for like a care trust, the aging of America's baby boomers, our 65 plus population, our 80 plus population between like 2010 and 2040 will have more than doubled, right? We're going to have 80 million Americans that are 65 or older. In less than 5 years from now, we'll have doubled the number of people that are 80 plus. That means more hospital stays, right? That doesn't necessarily equal better economic results for business in that space. So,
yeah. And just to add on that too, like you were saying, good capital allocation, that also comes down to like good balance sheet, like operations. And this is just a business that has took on way too much debt. They could say like, well, they're hospitals, they're stable revenue generators because people are, the hospitals pay their rent, I guess, but they levered up so much to do it. And they also had an individual tenant that was a large one. I think it was called Steward. Basically like they did a lot of very favorable development deals with them where they were like giving them money to, do improvements for hospitals and things like that, which it's not uncommon in this industry, or actually in any real estate industry, where they will give rent concessions to tenants who are making physical improvements to their facilities. But some of the carve outs that they gave to Steward were enormous. Not only were they like, the landlord, but they also were like lending to them to do these developments. And so they were very, very tied to this not good hospital operator. And when Steward went bankrupt, and it wasn't just like a Chapter 11 reorganization bankrupt, this was a Chapter 10 liquidation, sell the hospitals to other people sort of bankruptcy event. It's been extremely challenging for Medical Properties Trust. I mean, if we talk about, you go into real estate investment trusts typically for like stable revenue, stable dividends, decent yield, little bit of growth on that dividend. Since 2023, I think, let me just this was a case like, they saw a dividend cut in 2009, kind of acceptable, right? Like it was a great recession. Everybody was really struggling. But since then, like they've had 2 dividend cuts in the past 5 years because their balance sheet was a mess. They had this Steward problem they had to get to, and they just needed to free up cash. And they went from a 29-cent per share dividend in as recently as 2023 down to 8 cents per share on a quarterly dividend. So it's just a business that's really, really struggling, not just from the thesis of like being a hospital operator, but also just not the best at underwriting who their tenants are.
I just want to comment right here. SB has dropped a couple questions in, and one was about Abercrombie and Fitch, ticker ANF. Unless I'm mistaken, I don't think that's one you've done much research into.
No. So do you see what we're wearing? Do we look like fashion forward people? Come on now. I mean, I know Jayson's got those wonderful flowing locks.
I made videos with you on Estee Lauder, pal. So you go where the financial statements tell you to go. So.
That is very fair. And to Abercrombie and Fitch's credit, they've had a pretty spectacular turnaround in terms of like, they brought in some new people to, refresh their designs and things like that. And they, targeted a new demographic. This was something that was heavily teen. Certainly I would say my high school ages. So like the mid to late 90s, I guess even into the early 2000s, this was a very popular brand. And so it was a huge growth story too. Yeah. And so they did a lot of like, portfolio refresh around like retargeting that demographic. Like, hey, were you a teen in the mid to late 90s all the way up to the 2000s? Well, we're just going to make clothes for you now and today. And it seems to be working. I think they had a wedding portfolio that did quite well for a while, surprisingly. Not like wedding dresses, but like,
you don't know anything about this company, but you're going to talk for 5 minutes about facts and figures about Abercrombie.
Oh, come on. There's a Brookfield question in here. We're going to go 20 minutes on Brookfield in about 5 minutes here. So give me a break. Yeah, I think it's an interesting story. I'd have to look back into the financials again. The question is like with any fashion forward sort of business, like
remaining relevant,
just like what happened a few years ago or several years ago, you fall out of favor and it you start the whole cycle over again. It's, you know, the circle of fashion life.
Yeah. So value trap question mark. I think that's the thing. I've asked Adam to leave the question in the queue because there's a good chance another fool will come on in the next few days that may have better insight. So we want to make sure there's an opportunity to give a little bit better answer there. All right. SB also asked, so we're going to wade back over sort of into energy, because here's the reality. Renewable energy ain't in the energy sector. Again, it's oil and gas and coal, right? That's the energy sector. Utility companies are not technically energy companies, but for our purposes, we're always up to talk about companies that have some role, whether it's molecules or electrons, in powering the world. And in this case, SB is asking about Brookfield Renewable. So the question, do you see this as a market beater, including dividends? And then mentions Microsoft as being in the headlines recently, saying that they're open to using fossil fuels for data centers. So I'm going to draw some threads together here. BEP, that's Brookfield Renewable Partners. That is a publicly traded partnership. And that and BIP, Brookfield Infrastructure Partners, those are the only two publicly traded partnerships that I am willing to own inside retirement accounts. There's also BEPC and BIPC, which are corporations. So the 3-digit tickers trade for a lower price consistently, because we're talking earlier about the Schedule K1s you get and that pass through on the taxes, that the tax effective dividend is different than the real dividend. If you are paying taxes on the dividend, being able to own them in a retirement account is a wonderful superpower to be able to get a better dividend. But you do still have to deal with the Schedule K1s. So all of that to say, what does it do? Renewable energy. They invest in, build, acquire, and finance the utility scale wind and solar and hydrothermal and hydroelectric. Sorry, not hydrothermal. See, I'm combining words there. They don't do geothermal, but they probably will if they see it can make money. But they invest in these projects, and then the power is sold on those projects in like 20-year contracts, kind of like we're talking about with the pipeline businesses. Very long-term contracts. So you know what the cash flows are going to be. They know their debt profiles, their cost of capital to figure out how to make money. So with the question, can this be a market beater, including dividends? You have to include dividends to think about the potential for this business as a market beater. I'm going to share a screen here, Adam, if you give me just a moment to grab it and send it over, that just shows over a long period of time how the business can perform. So you see the school bus yellow line, that's Brookfield Renewable Partners total return factoring in the dividend. This goes back to the beginning of 2010. So we're going back a long ways. 518% total returns. It's underperformed the market. And now for much of that period, it has outperformed the market. I think right now we're in one of those periods where the cycle has turned decidedly negative on the business and it's underperforming the market. But look at the difference in the total returns versus just the stock price. You know, we're talking huge. I want to annualize that just to kind of make that number easy to digest. The stock price has gone up about 6% a year versus 12.7% in annualized returns. Hasn't, from the beginning of that period to the end of this period, has underperformed the market. But last I checked, that's better than the market's long-term average. And I would expect, based on the strength of the business, the optionality they have to invest in different countries and the different asset categories across the energy space, the demand for the yield and returns that these assets can get, and their relationship with Brookfield Asset Management, which those funds, their energy transition funds, finance a tremendous amount of these investments, kind of that top of the funnel, and giving them access to this, where they're then the operating partner for those assets. I think this is an incredibly, I think the odds are very favorable that you get market beating performance, market long-term average beating performance. If we see another 15% a year rip, over the next decade or so from the S&P 500, I don't think Brookfield Renewable is going to outperform that. But again, compared to that 10% a year average long-term return, I think the odds are pretty favorable. You do better than that. And it's a wonderful dividend growth story. So if dividend growth is something that is high on your list of things that you want, I think it's a very, very compelling investment. Anything to add, Tyler?
The one thing I would add, because the comment about, Microsoft saying they're open to using fossil fuels for data centers, I think a lot of people look at energy through the lens of, renewables versus fossil fuels versus, hydro, whatever. I think what is more important when you look at businesses like this is not necessarily what type of power they're using. It's the people behind those businesses making those decisions, how they are putting their money to work. Because just saying that they invest in renewable or they invest in hydro doesn't really explain well what they do, because yes, that is factually true. But what Brookfield has done historically so well is they just don't buy solar. They don't just buy hydro. They buy
They're
things that are
value buyers.
way, way undervalued. Like they bought
Yeah.
Colombian hydroelectric dams because nobody wanted to touch them in the early 2010s. They bought a major solar development firm out of bankruptcy because it had these giant assets that were selling for like 10 cents on the dollar. And it's things like this that I think over the long term are going to matter more than the type of power that they develop, because you're trusting in management to make good decisions with the money that they are going to have, whether it be maybe they will find a natural gas turbine in Poland trading for 7 cents on the dollar. They will have a problem buying that if that's the case.
I think Brookfield Infrastructure would get that deal before Brookfield Renewable would. But your point is incredibly valid. This is built into the entire ethos of the Brookfield entities, being value buyers of these assets to get good return. Now, the backdrop is the biggest deal they've ever done was with Microsoft. And the one deal that they did with Microsoft, if they fully build it out, on the total size of the deal, would increase their annual generation capacity by about a third. It's a pretty substantial deal. But even without that deal being fully reached, the pipeline of opportunity in front of the company is pretty wonderful. We should promote
shameless plug hour while we're here.
Yes.
Tomorrow, for one whole hour, Fool members know this is one of Jayson's favorite topics, and we're going to indulge him for a full hour of Brookfield programming. It'll also be available on YouTube. So if you are interested more about,
it's going to be on the YouTube hour or not.
Yes, it will.
That's right. It begins at noon. So noon Eastern tomorrow. Yep.
We're all going to indulge Jayson with all the questions about Brookfield out there possible. So if you've been here, you have questions about Brookfield, we invite you to ask them then. I don't even know why I'm going to show up. I might just let Jayson pontificate for like an hour.
No. Trust me. The world needs you to intervene here. We're going to need an intervention. So, but no, there's risk and concerns that I have with Brookfield that I think are worth exploring too. So we'll talk through that tomorrow. So, all right. Well, we're down to around 5 minutes or so left. Let me just hit this real quick. A Pro Shop guy wrote, energy and financial sectors are in the too hard to pile. Cyclical commodities and valuation based on book value financials are counterintuitive. I'll leave it to the experts like you guys. I will say this. One of my favorite things about investing is you can build a diversified portfolio without owning something in every single sector. Like the idea that the by the book idea that you have to have exposure to everything, I don't necessarily know that it's true. You can be diversified enough and still do perfectly fine without owning a little bit of everything. And you're better off avoiding something that you don't know, because if you don't know it, you're going to act based on what the stock price is doing, which is unhealthy and dangerous, versus what the business is doing. So it's better to avoid an unforced error by just not investing in a particular category, and you can do fine. Just buy a little Brookfield and it'll make up for it.
My addition to that too is I think we all have a too hard pile. We all kind of, there's those things we just look at and admit, man, that's tough. I don't know if I can ever get there. I think healthcare and biotech tends to fall into that category a lot, and banks and commodities seem to be like the three sectors where people are like, man, that's really hard. But my one advocating for this a little bit, because I wouldn't say I'm a great healthcare analyst. I'm starting to scratch that itch a little bit, and same with banks too. I've been a energy commodities guy for a long time. It is worth flexing that intellectual muscle every once in a while, even if it's something that you've never flexed before. It's definitely worth exploring it every once in a while, because industries like banks, like healthcare, have been spectacular sources of outperformance over the years. I mean, I know we talk about like the big banks like JP Morgan and Bank of America and things like that, but there is just dozens upon dozens of small and regional banks that over their entire lifetime have
Just incredible
been
compounders.
market crushing stocks.
Yeah. And they're
And
still
so
small and unheard of, except for by the people that are in the region they operate that do business with.
Yeah, they might have like 7 shareholders because it's a regional bank in Stockton, California, or something like that.
Right.
But
They have 4 branches,
but
all in the same
and
town.
they're publicly traded, and they do killer returns. And
Yeah.
so to me, it's, I think, as much as we like to sometimes put on our comfort blankets of going to tech or going to consumer goods or something like that, it is always worth trying hard things every once in a while and learning a new sector, because I think you'll be surprised, especially in places like banks and healthcare where there aren't a lot of people fishing. There's a lot of opportunity to pick up very mispriced assets, because with all the people that cover Nvidia and Tesla and Microsoft, I really struggle to see how that's ever mispriced.
Yeah, no, that's exactly right. All right, so we got another couple minutes before Tyler is going to be taking the rest of the evening for him off, and Lou Whiteman's going to be joining me for the next hour here. Besties writes, Jayson, I recall a few years ago you were fairly bullish on elderly care. How is that going? So I want to, there's a little more context on that I think is important. As an investor, I do tend to look for trends, big trends, and then try and find trends where there's economic opportunity for companies to grow earnings per share and create value. And one of the biggest trends that's affecting a lot of the world is the aging, the transition of baby boomers out of their income earning prime years, moving into retirement. And it's happening in it's happening in the US and Canada. It's also happening in Europe, maybe even a little bit of an accelerated pace in Europe. It's also happening in China. China is going to get very old very, very quickly. So there's implications for that. The US seems to have a little better economic path forward, in large part because of immigration that's maintained economic growth, replacing people as we continue to see them move along. So I have focused really on companies that can do well in the area of healthcare, and CareTrust REIT is the one stock that I've consistently bet on. I'll talk about that as we transition onto the next hour. So I'll leave that little cliffhanger there.
Well, so actually we have 1 minute left, so maybe I can answer this question in 30 seconds. We'll do it really quick, because as it was another besties question as well. It says, how do you make money with energy stocks? Solar and wind being another kind of category. I can ask the same for biotech and pharma. Energy, it is a challenging industry. We were just talking about, flexing that intellectual muscle. It's a hard one. There are places that have done better. I've mentioned it before. Integrated oil and gas companies have been very good investments over the long term. Refining companies have, over the past 15 years, have been very, very good investments. There's some structural changes in the industry. We mentioned pipelines tend to be much more stable businesses, and then you get into the wild, wild west of services and oil and gas production. But there are places that you can get into in this industry that do make a lot of money on relatively consistent basis. And if you're only trying to learn to dip your toes, I wouldn't say just dive right in and start buying energy stocks indiscriminately. It takes some time, but I think it's an industry worth knowing, and an industry worth pursuing every once in a while, because there are pockets of very good companies in this business, despite I would say the negative aura surrounding it.
Yeah. No, that's fair. All right, Tyler, let's wrap this up here, and we'll bring Lou Whiteman to the screen, and we'll send you home.
Yeah, it's been a good hour. 2 hours for me now, and I guess we'll hand it over. Just waiting for Lou to jump in. So we're filling time with dead space, and there he comes. So I get to stop talking now.
Well done, Tyler. That was
Good night, guys.
the most seamless transition I've ever seen. Hey, Lou.
Hey,
How you doing, buddy?
I'm loving life. Just here to take us up to the big Watford game today that I know everyone's looking forward to. But
Let's talk about mid-level English soccer that nobody's interested in, except for the millions of people that are interested in it.
That's right. Or we can talk stocks. Hi, fools.
Okay, let's do stocks. I like that idea better myself. Hey, everybody, welcome to another edition of Fool24. We're getting into the 2 p.m. Eastern hour. I'm Jayson Hall. If you're just joining us, Lou Whiteman is here with me, and we do want to answer your questions. Get those to us at slido.com. The event code is Fool24, all one word, Fool24. Get that into us. And as always, please remember, we're happy to answer your questions, but we are not giving you individual or personalized investing advice. For a million reasons. We don't know your situation. We don't, ethically, it would be bad practice for us to give personal advice to somebody on the internet that we don't know anything about their situation. So we do not do that. Lou, it is our Ask Us Anything hour. So is it anything, or just sort of anything? You can ask, but that doesn't mean we're going to answer anything. Maybe that's how.
You know me, I'm really focused on giving out relationship advice. So if we can get that, but otherwise stocks, we have some big earnings. We can talk Adobe, we can talk SentinelOne, some of these. We can talk about whatever you want, fools. I was really curious to hear, longtime listener, first time caller, about Care Trust.
Yeah. So I'm going to pick that theme up then right here. Let's start off with that, since I did tease with that. So again, the reality is that pockets of the healthcare industry are extremely profitable and pockets of it are extremely challenging. And in a lot of cases, the closer you get to caring for the patient, those are the businesses that can be extremely challenging. And for Care Trust, its core business is seniors housing and skilled nursing, mostly nursing facilities, rehab facilities, that sort of thing. Which again can be a really, really tough business. So Care Trust was spun out of, was it Tenet, I believe? I'm going to have to look it up and see. I can't remember exactly who they were spun out of, but they were spun out, and one of the founders of that company went with Care Trust at its founding, and it was a healthcare provider that they were part of, and they spun out a big portion of their real estate assets into Care Trust REIT as a real estate investment trust. And what their target has been, and I guess it's been about a dozen or so, 13 years or so since it was spun out, was to continue to acquire properties, partner with the best operators that they can partner with, and at the same time reduce exposure to their former parent company, which was by far its largest tenants. And they have largely done that. They've had some tenant relationships that have been very challenging. Going through the pandemic was brutally difficult for nursing home and skilled nursing facilities. Just absolutely brutal period of time. And they had to work some deals with some of their tenants, some deferred rents to allow them to stay solvent to get through that period. But largely they emerged from it unscathed. And they had a few tenant relationships that they ended, and they had existing partners that took over operating those properties. So really, really good at those transitions. The key for Care Trust is capital discipline. This is really where it all starts with the business. Maintaining an extremely strong balance sheet has always been important. Really low debt leverage ratios, so you have some slack in the system, some margin of safety. If you do have tenants that are slow to pay or can't pay, or go through bankruptcy, that's what kind of thing happens, right? So you build some slack into your system so you can take those hits and it doesn't affect your ability to make your own payroll and to pay the dividend back to your shareholders, right? So they've done a really, really good job with that. And it's also allowed them to be very opportunistic and to move quickly when there's opportunity to make acquisitions. So as much as we think a lot of like big healthcare providers, these giants, this is a massively fragmented space, massively fragmented. The vast majority of these facilities, the owner owns 5 or less, the vast majority of them. So there's a lot of opportunity to accumulate and consolidate small players. And for CareTrust, because it's still relatively small, it has less than 300 properties, it can make small acquisitions that over the period of a year can be meaningful towards being able to grow the business, as long as you're disciplined with your capital allocation and smart about it. And they have been. A couple of years ago, one of the things that they moved into is treatment facilities for addiction. And that's been slow to grow. They've been really mindful about growing that and learning more about the industry. And one of the things that's interesting about that particular industry is that there's a lot of private payer insurance that's involved, which improves the economics. So that's one thing that has made that particular growth channel something that's been appealing to the business. Here's the big one for me. I'm going to bring this up on the screen. Adam, I'm going to have this ready in just 3, 2, 1, and it is to you. And you see the blue line. This is CareTrust stock. Again, going back to 2010, just kind of actually, I don't think this goes back to the IPO, which was 2012, 2013. The stock has done extremely well in total returns. So, the stock price hasn't gone up, but paying the dividend and then the dividend growth. I'm gonna shorten this up a little bit.
Yeah, I was gonna say shorten it because 3 years you'll see almost a double. I think even over the last year they've beaten on a total return basis.
So this is 5 years, and I'm cherry picking a little bit here. If we go to March 23rd, roughly, this is kind of the bottom of the pandemic. We see it's done fine. A lot again. The reason this has happened is the initial sell-off happened. And then this period here is going through the pandemic. It was such a tough operating environment for these operators. But again, you see, like I said, the stock has done a little better more recently. Again, a little bit going through the same sell-off since the fall. But what we see is a long-term compounder. Their ability to generally grow the dividend over the long term, be disciplined about the way they buy, not try to meet Wall Street's demands, but be smart, value-focused buyers of property to expand and maintain strength in that balance sheet. That's why CareTrust is the one that continues to remain in my portfolio. All right, what's next?
Yeah, no, I'm just reiterate. I mean, I get asked sometimes, like these dividend yield companies and this one to me, you outline the risks well, but they're still paying a 4% yield, just a company that
4.4. Yeah.
All the demand in the world, you can see the secular trends, and just one, I'll accept I understand the risks, and I accept that, and this to me is just one to hold on to.
Yeah, I think so. So this speaks to the economic strength. One last thing, and then we can move on. I just sent another screen share over, Adam. So again, this is even through that tough period, still was able to consistently still grow the dividend. Modest growth, not a ton of growth, but it's up 16% over the past 5 years, and that's not nothing when you consider how tough the environment was for its operators and how their business translated to still being relatively strong even during that tough period.
Yeah. All right. I see the questions coming in. The symbol for Brookfield, that one, just to get real quick. I mean, BN is the basic one, but that's a loaded question with Brookfield.
So where's that question here?
RAM right up top. What is the symbol for Brookfield?
Okay. So it is a loaded question. Yeah. So Brookfield Corporation is BN. Mm-hmm. What I've been talking about is Brookfield Renewable, the renewable energy company. That's BEP. That's the partnership, the public traded partnership. BEPC is the corporation, Brookfield Renewable Corporation. So those are the relevant tickers. We're doing a whole hour tomorrow at noon Eastern. Me and Tyler. I'm not going to talk anymore about Brookfield this hour. Promise.
Yeah. All right, here's one that I think we talked about earlier and that we can kind of quickly get. Mary Ann Kelty says, can Motley comment on Redfin, given that it looks like it'll be acquired? Would you generally recommend a hold or a sell at this point? Motley Fool, I'm sure, has commented on it in the services. We can't comment for them. What I can tell you is that hold or sell at this point really comes down to what you think of Rocket Mortgage, the acquirer, because the deal will, we can't say for sure, but the deal will likely go through, but it's
an
not
all-stock
cash.
deal.
Yeah, it's not cash. It's an all stock deal. So when this deal is completed, assuming it is completed, you will get shares of Rocket Mortgage. If that is of interest to you, if that's a company you want to hold, it will include the Redfin business with the Redfin management, but there's a lot more going on there. You should hold it. If not, there really isn't much reason to wait around and see if it gets acquired. But when you sell, that's kind of up to you. But your choices right now, basically, assuming the deal goes through, is to either sell the stock and take the cash, or don't sell the stock and be a shareholder of Rocket Mortgage. And that should come down to what someone thinks of Rocket, or what if they want to hold that security.
I want to build on that just a little bit.
Sure.
Since we're still on YouTube and there's folks watching that maybe aren't a subscriber to one of the Motley Fool service, there, without giving too much away, I think there are probably three services that might still have it as an active recommendation. Each of those services is going to provide guidance of what they recommend members to do. I don't think any of those are portfolio service. I think they're just all stock idea services. So the analysts that run those services will put out their thoughts about the deal based on the goals of those services and what they suggest members do. But yeah, you're exactly right, Lou, about making the individual decision about whether or not you want to own Rocket Mortgage. But the one thing I want to explain, and we've talked about it before, we talked about it this morning, but it bears mentioning for anybody that didn't watch us before, because this is an all stock deal, that premium, that $12.50 per share price that was put out there for Redfin, that was based on the closing price of Rocket stock Friday afternoon. So as Rocket stock moves up or down, it's going to change the actual value of Redfin stock. So what we're seeing is as Rocket stock moves around, Redfin stock is generally moving around. What did you say the multiple was? It was like 0.7.
Yeah, so I'll give you the as of right this second. Yeah, if the deal closes as scheduled, for each Redfin share you own, you will get 0.7926 shares of Rocket. Rocket is currently at $14.02. That implies about $11.11 worth of value. Redfin is at $10.29. So if you saw the headlines pre-market when the deal was announced of $12.50 per share, and you're thinking, why should I sell at $10.31, or which I think was the last tick on Redfin, just understand that it's not quite that gap. There is still a gap because there is still, until a deal is done, some uncertainty, and sometimes these things don't, trade down to the second. But if you're considering holding on or holding out for a higher price now, understand that is totally tied to the Rocket price. So you take the Rocket price at any given time and multiply it by 0.7926, and that is the economic value you will get for every share, assuming the deal is completed.
So I sent a screen share over, Adam, if you want to release that too. So yeah, that was at roughly $16 a share. It was a little below $16 a share when Rocket stock closed on Friday. That's the number that it was based on, just below $16 a share. So we've seen, again, Rocket stock came down pretty sharply after the announcement, and it's come up today. So if we look at today, this is always fun. What do you see? Pretty close to lockstep correlation between the two. And that's likely what you're going to see going forward. Mm-hmm. And again, there's a discount. Like you said, it's roughly $10 and change today.
So
versus
about
what?
7%. Yeah, 6 or 7% right now. So you can run in and chase those pennies if you want and get cute with buying and selling and shorting and stuff. But
it's all based on what this number does, right? That the price. So you don't know where this is going to go, which means that capturing that difference in arbitrage is you're making a guess, right? We're all making a guess about that. So it's really about whether do you want to own Rocket or not, and whether is now the right time to sell, or holding to get to a year on taxable gains if get that long-term gains rate or something like that. And if you do or don't have an idea now where you would like to put that money to work, then making the best decision for you. So, okay, what's next?
All right. What do you say? There's one with your name on it, but I don't want to throw it at you if you don't know the company. Do you know Pax Group at all?
I don't follow it. No, I don't.
LY winners win. I can't really answer. Jayson, another elderly care company mentioned by Tom Gardner was Pax Group. Thoughts on that one? It's PACS. I'll give you just a couple things. I don't know what Tom said, but for one, it's in considering with Care Trust, it's not a REIT. Which, good or bad, it's just, but you're not going to get the same income. Also, there's been a lot of headline risk tied to this company of late. It's reflected in the stock price. If you look at that stock chart, it went from about 40 to it's about 12 now. There's a Hindenburg report out on it, which is a short service that it's talking about accusing of Medicare fraud. That's far. These short reports are always interesting, but you don't. I mean, I'd have to dig in before I, gave it any credibility or not. But they also, it looks like, were delayed in getting their, getting their. What's that? They had a late notice filing back in November too. They were delinquent in their filings. The consensus I've seen is that it's likely to be a material fine and nothing worse that comes out of what Hindenburg identified, but that is all speculation. So just there could be great opportunity there with the drop, but it is a different profile of company from what Jayson was discussing. And there is, make sure you read up on the headline risk and read that short report and kind of come to your own conclusions on that.
Yeah. The reason that I don't follow it is because they're also an operator. I mean, they're a provider too. So I'm not interested in those businesses. It's such a tough business. Yes, there is opportunity. All of the tailwinds are there. That could make it compelling, but I put them in my too hard pile because it's so hard to find the ones that at scale can create economic value for investors. So that's why I've never really.
Right. No, and I agree. I mean, you can play the trend with the real estate. To me, I mean, that is a perfect opportunity to get an income stock. You probably don't have the gain potential you have, but you also have a lot less risk. You know, there is still risk, but it's a very different investment profile. And for what I'm looking for there, the REIT, just the real estate, makes a lot more sense.
Yeah, and to follow up to Bestie's question, I talked about it. You may be a little bit delayed on the stream. I did talk about Care Trust, how the business is done over the long term and the more recent term. I look at it right now and I think it's an opportunistic buy. The market has turned a little bit negative on that sector, but this is one of the strong operators that has capital when others don't, and that puts them in an opportunistic position that is really, really advantageous. And I think they're built to take advantage of the long-term tailwinds. So yeah, I think it's really interesting right now.
Yeah. So do we want to hit on Adobe or any thought? I mean, we have a bunch of companies reporting after the.
Yeah. So let's do that. Maybe this will kind of spark some engagement too. So here's some notable companies that are reporting after the market today. We have Adobe. That's definitely the biggest company reporting. Crown Castle, which is the real estate investment trust that owns telecommunications asset, mostly cell towers, and mostly in North America. And then Williams, I don't think Williams Sonoma actually reports today.
You had said, I think SentinelOne does.
SentinelOne, yeah. So SentinelOne, I think, is really interesting, and this is one that's on my watch list, because it's emerged as an alternative to, I shouldn't say it's a competitor to CrowdStrike. It does the same thing. It's a much smaller business. Its unit economics are not as compelling so far. Its growth rate is slower, has been slower. We're going to find out if maybe that's changing a little bit. But what we have seen from CrowdStrike since the outage last summer is some challenges with its growth, where they're having to spend more to retain customers. The growth rate for net new business has fallen substantially. It's still growing net new business, but it's growing at a much slower rate. And And SentinelOne's business looks like it's steady Eddie. So I'm looking for some acceleration there. And it's also still a money losing business. And where it is in getting to scale to getting to positive cash flow, it's directionally, it's looking really good. So I'm looking to try to figure out when is it going to kind of reach that inflection point with its cash flows, because I think it can. But it just looks like it could be another winner in cybersecurity and endpoint protection, because the CEO of CrowdStrike, oh goodness, what's his name? The founder and CEO. It's killing me. Anyway, he
George
said,
Kurtz.
thank you, George Kurtz, laid out a path for the company to still be 10 times larger than it is now in terms of revenue. That means it's a really big pie. And we see a lot of companies where there's one just enormous winner and not a lot of other big winners. But I do think SentinelOne is compelling to me right now. So this is one that I'm definitely going to be looking at in the next few days. Maybe tonight. Talk about it tomorrow morning.
Yeah. Adobe, I'll take it. Adobe is kind of fascinating to me because they are kind of front and center in this whole, what will AI do to companies debate. There is a lot of back and forth about whether or not AI and the cool tools that you can now use from your home, will that disrupt Adobe, or will they be able to take advantage of it? I'll tell you, I love on my Google Pixel, I can just delete things in pictures and edit pictures and stuff like that just for free. And that's something that I would have had to own Photoshop for years ago to do it, and paid a lot. I'm of the position, or I'm of the thought, that it's actually going to be a net beneficiary of Adobe. It's just the business case has changed. 5 years ago, Adobe's path for growth was to get all of us to buy a kind of watered down version of its tools. And like the consumer was the growth engine. That's it's tough to go retail. Mm-hmm. I think that those aspirations have largely been killed by AI, or will be killed by AI. I think just baseline tools will be available for free. That will mean that, like, just for you and I doing stupid memes for the internet, we can probably get by without it. However, I continue to think that the creative class, these professionals that pay through the nose for Adobe products, they are not going to downgrade.
No, they're going to get supercharged by AI.
Right. And I think Adobe is well positioned to add AI to their core products and make them even stickier for their core customers. We will see. I will say this, all of that said, I think this is going to be a crummy quarter to really learn much. If we've seen from Salesforce, if we've seen for so many of these subscription-based businesses, just like what we're seeing in the consumer economy, there is just a lot of, I'm not ready to say recession, slowdown, permanent, but there's just a lot of halting or not overextending right now. I don't know if it's going to turn out to be a great quarter for them or anyone else that is sort of courting business customers to spend more on anything other than the really, really essential. This is a tough time to get I think anyone almost in the corporate world to spend on non-necessary, like non-cybersecurity, non-stuff. So I don't know. I don't have high expectations for the quarter, but I'm also not convinced that my kind of optimistic outlook for Adobe is really put in jeopardy by this quarter, because I think there's a lot going on right now.
Yeah, no, I think that's a good way to think about it. I want to take a couple of questions here. Sarah E, I think Sarah E, I think you're talking about Sabra Healthcare REITs. How do you compare CareTrust to Sabra Healthcare REIT? What I found broadly is that the thing that separates CareTrust from everybody else in the space, Welltower and others, is number one, a lot of them, like Welltower, for example, is much, much larger. Sabra just hasn't been a great capital allocator. The balance sheet hasn't been as strong. And when you're in that sort of business, you have to prioritize those things first. Because if you're just chasing, there's always something out there you can buy. Always. That doesn't mean you should buy it. And to me, that's been the core of what has made CareTrust consistently the one operator in this space that I've been interested in owning. Anything to add there, Lou?
No, I mean, yeah, I think, yeah. And again, this is everything we just said about characters. You do need to find the right operator. I like the operator I have, so I haven't looked around too much more because I don't want to have my whole portfolio there. But yeah, I do think it matters who you invest in, and you got to take your chances with kind of who's performed for you.
Yeah, no, that's exactly right. All right, I will say that Vihan has given me one of the 3 biggest compliments of my entire life, comparing me to Albert Einstein, not just the resemblance, but also in my stock research. So I will say thank you very, very much. Vihan and Einstein apparently share some education background. That's pretty awesome. Thank you for sharing that little tidbit there, Vihan. Ram asks, is it good to buy when the market is volatile as it is now? Lou, my one question, or my one answer, single sentence answer to that question, you know how hard it is for me to just answer in one sentence, is I try to buy the best companies that I can buy at a price that I think will work out over the long term whenever I have capital to deploy in that particular business. I try to, as much as I can, ignore the noise of the market and the situation and deploy capital for the long term. And sometimes volatile situations like right now give us opportunities that we didn't have a month ago or 6 months ago, right? So we had a lot of volatility after the election in November when stocks were going up. We don't call it volatility when it's going up. We call it a bull run, and we say it's volatile when it's going down. Volatility works both ways. But I really do try to ignore as much as I can whatever's rattling the cages, and just allocate the capital as best I can in the businesses. And because you can it's so easy to see a stock that's moving a lot and decide not to act because you're waiting for the perfect price at the bottom, or to act expecting the whatever momentum's been sending it up to keep sending it up, and then your expectations to get messed up, right? When that stock that you're sure was going to keep falling bottoms out and then starts going up again, or that stock you thought the momentum was going to keep moving it higher, something changes the narrative and you bought it and now it's going down, right? And then you react in the opposite way. You make another bad decision, you compound the mistake by making another mistake and just act based on the stock price versus the quality of the business and getting a good valuation, and then letting the businesses do the hard work over the long term. I know you can add to that.
Yeah, I mean, but no, I think the answer is right. I mean, is now a good time? That all depends on how you're going to react to volatility. It can be a great time to buy. It's just you need to know yourself. If you are going to buy and then say, oh, shoot, what did I do? If it goes down, if whatever you bought is down 5% 2 days later or more, then you probably should hold off right now, because we tend not to make good decisions when we're jumping in and out of that. If you are able to say, I always say this, like, look, if you're thinking about buying a stock, just base it on all of the data you know today, not what you thought 2 weeks ago, not what you maybe wrote in a journal a month ago about what you wanted to do. It's just you're making a decision based on what you know today and what you think. If you can stand by that decision, and hopefully if you're buying today, you're thinking out the next 5 years. You're not trying to figure out what's going to happen in the next few days. Just remember that and tell yourself that as things change, because I tend to think for a lot of investors, a time of volatility isn't a good time to buy, simply because it is so hard to keep your emotions in check. So it's better to kind of just opt out. But if your time frame is 5 years, 10 years, whatever it does, even if you miss the bottom and it ends up going down from here, if it still goes up over 5-10 years, you won't remember that. Yeah. So if you can tell yourself that and stay good, I think sure, buy, but be honest with yourself.
Yeah, no, that's right. And I think there's some tools that we can use too to help us act in our own best interest in these environments. And one is, if you have a business that you're really compelled to own and you want to buy some, but the volatility has you paying way too much attention, maybe you just buy a little, right? You don't buy a third as much as you would plan on buying, or half as much, or whatever, and then have a plan to follow the business. And if the business continues, again, try to detach it from the stock price and start with, is the business doing well? And if the answer to that is yes, then look at the stock price and the valuation 6 months later. Okay, it's now time to put the other half of this money to work, or another third of it to work. Spread out your buys is a great way to kind of help deal with some of that emotional pressure we feel to act quickly. Maybe you make a decision you regret. It puts the power back in your hands to be able to act in your own best interest. You buy and the stock continues falling, and you look at the results next quarter, and you're like, what, the business is doing well. The stocks continue to fall. I still have money to invest in this business, and I think the business is winning. The stock is detached from the market. I can invest. Or maybe it's the other way around. You have control over the situation and the way that you're going to respond to it, which can be really, really useful. Okay.
Let's Dave J says, anyone else think European defense, aviation, and cyber stocks are in for a decades-long upswing? I have no idea about the decades thing, but I do think that one thing that we are seeing right now is maybe the awakening of Europe, or Europe kind of coming into itself.
You want to call it a renaissance?
A renaissance, yeah. But actually, we'll talk about that in a second too, because I actually think that is interesting. Because I am not sure now is the time to buy European defense stocks, and I'm going to tell you why. We talked about this before, Jayson, but it is really, really hard to time the market in defense stocks, even if you believe everything. I mean, I could tell you a very clear story here about how European defense stock spending will go up from here. The Europeans are less willing than they were maybe 2 years ago to just buy U.S. stuff. That should translate to more sales for European defense contractors, and there's some good ones. The problem is that even if that does come to pass, it will come to pass over a 5 to 10 year period, because a lot of these
deals is not deciding to move over to Microsoft Azure from AWS.
Right.
And you flip
deals signed today are going to need 5 years to bear out revenue. But what have the stocks done? Adam, I just sent this over. Let's just look year to date of some really, really good European defense contractors. What do we have there? Renewable has been all over the news. These are they're mostly land systems, but this is a German tank maker, land systems. It's a double so far this year, basically a double in the last month or so. Leonardo, the big Italian company, it's an aerospace company, a lot of electronics, up 70%. BAE Systems, which is outside of the Eurozone, but it is the UK defense giant.
Right.
43%. I also put in because I just thought it was interesting, that is a pretty good European defense ETF, the one in green. And then the gray ticker, NATO, which is a combination of North American and European defense contractors. You can see that is the laggard here, which is kind of the US side of it. So for me, when you have such a long, drawn out, cycled industry, you cannot, it takes a while to justify these moves. So I'm not really interested in buying in right now, because if I could have predicted the future and bought in at the beginning of the year, I think, you'd feel pretty good about yourself. But that 100% gain in Rheinmetall, that is probably represents whatever boost in business it'll get over the next few years. I'll tell you what I think, though, and I don't know exactly how to go about this, but I do wonder if there are all sorts of parts of the European economy, some great companies that haven't moved like this yet. And I wonder if defense isn't just kind of the canary about what's going to go on in general. Europe has been trying to get out of its own way basically since the great financial crisis. Okay. It is really hard because they are both one combined block, but also with separate governments. It is really hard to move in lockstep. You think the United States is insane trying to get all the states to agree? Imagine if they actually had veto power. So we have sort of been
if it's the difference between the way our federal government and states are structured versus confederacy. Where each individual entity has far more control and influence, and their ability to say no to stuff that just stops everything.
I really believe that we could look back in history and say that this was sort of a pivotal moment for the European economy, where they figured out out of necessity. Things like Germany opening up spending for the first time basically since the Weimar Republic. I'm probably a little off there. Berlin Simon, if you're still on, you can educate me. But basically, we are seeing groundbreaking changes, which I do think will stimulate the European economy. So I am curious if this age, kind of unintentionally, but this age of sort of the U.S. stock market was the only game in town, which has been most of the last, again, since the great financial crisis. If you look at returns, it's going to take a while to play out. But if you're a thematic investor, I would be curious about how do I broaden my exposure to Europe now, thinking that this might finally be that turning point where Europe sort of accelerates from here. That to me, though, is outside of defense, just because, as I said, these defense contractors already up 70% in a month and a half or more. That to me isn't the time. Just my style of investing, I'm not going to follow.
It's not that they're up this much. It's the valuations they're now trading at,
right,
based on the results of their business going forward. Yeah,
right. Yeah, there's only so fast that these businesses can grow. So I want to be very mindful about how fast the stocks grow.
I'll just add one thing onto this, because Dave J also included cyber stocks. So I'm assuming you're talking about cybersecurity, and I do think that one of the things that we do know about the EU broadly is that it is far more anti-monopolistic and more privacy oriented with a lot of the regulatory environment there, in such that it could create an environment that's more favorable for domestic software companies. We'll see how that plays out. I don't know if that's going to prove to be the case in terms of creating more value, but we'll see. I definitely think there's going to be a lot more cybersecurity spend around the world broadly, whether it's U.S. based companies or otherwise that are the biggest winners from that remains to be seen. But I do think that is one of those areas where the tailwinds are just still very, very substantial.
Yeah.
All right. What do we got?
But just one more, since I did say aviation too. Aviation, I think, is
yep.
pretty unchanged by this. The commercial aviation market is a global market today. Airbus is the other half of the A and B duopoly with Boeing. Everything that we knew about that business 6 months ago, I think we know about today. I would not say that geopolitics has changed that as much where to really alter your thinking on it. Being
operated by grown-ups.
Yeah. Oh, yeah. Yeah. But grown-ups that are smart enough not to chase this rally, but yeah. So I would not look there. I do wonder, though, if we're going to look back on Europe in 5 years and say, wow, that was the moment that made Europe great again, where I shouldn't put it that way.
Wow.
All right.
I'm not touching that one, Lou.
Yeah. Yeah.
Okay. What's next here?
Besties was asking any update on Rocket Lab, or is it just down because the market has been? I mean, I'd preface anything on Rocket Lab, RKLB, with that it was up 400% in a couple of months late last year. And arguably, to me, the business didn't improve by 400% during that time. So we have had a retracement from that. I think that is more a reflection of kind of too much enthusiasm. And yeah, I think the stock does trade of late based on risk on, risk off, because it's one that tends to do better when animal spirits are running. In general, the business, I think it is steady as she goes. They did do a couple of things in the last few weeks that could have different meanings for shareholders. They did a $500 million shelf to kind of replenish their cash, which could be, mildly dilutive, assuming they go through it. So your stock, if they sell more stock into the market, each share is worth a little less. But they also continue to acquire really good businesses. Marinic is a business they acquired to help with the satellite manufacturing process. The whole story from Rocket
laser optical folks.
Yes.
Optical communications. Yeah.
Yeah.
Speaking of Airbus, they did a deal with Airbus recently too, didn't they, to put some satellites up?
Yeah. Well, they constantly have. Yeah. Yes. Their launch calendar is constantly getting refilled. So that that to me is business as usual. Marinic is interesting to me because, again, they have set out, and the reason they did the SPAC was to raise money to try to be a one-stop shop for a corporate space customer, that we will design your satellite, we'll build your satellite, we will launch your satellite, and we will monitor and maintain it. Marinette brings them some of the components to that satellite in-house, which I think helps them. I do think that, look, the enthusiasm was always getting ahead of the company, and for good reasons, because they do really cool stuff and they have a decent track record of actually doing it. They've turned from science project into business, but this was always going to be a long-term story where when the stock goes up 2x, 3x in a matter of months, it's inevitably getting ahead of the business, and the business is still going to take years to play out. And yeah, I think the gyrations are now more emotional. If you're invested, hold tight, especially through volatility. If you're interested in it, I think it can be a market winner, but it will take time, and space is hard enough that it should be a small part of a well-diversified portfolio. Just leave it at that.
I'm going to grab Ed's question about some of the large banks, some of the large regional banks, and some of the large investment banks. So Ed asks, how would you rate these financial stocks? Citigroup, Wells Fargo, Truist Financial, US Bank, and then Goldman Sachs and Morgan Stanley. You'll see the tickers on the screen are going to come up for those. If you own these, which one would you sell to raise cash? I want to be really careful about answering this, Ed. As you know, we want to be mindful about not, when we answer questions, sometimes it can sound like personalized advice, and I don't want anybody to hear me say something and thinking, oh, Jayson's saying that this is what I should do. Don't know yet. Don't know your situation. You're a regular listener and a regular questioner, so you know this, but I want to be clear for everybody. So I'm saying this by proxy to you, talking to everybody. There is no personalized advice here. Of this group, the only two that I have ever, of the three that I've owned, Wells Fargo, Truist Financial, and US Bank Corp. I haven't owned US Bank Corp in quite some time. I sold Wells before Buffett did. So there you go, Warren, take that. And Truist Financial, I sold kind of late last year, sometime during the fall. I bought Truist Financial in March of 2023 when we were going through the banking crisis. Signature Bank, First Republic in California, and Silicon Valley Bank all failed between early March and early May. All three were seized as two of the three largest banking failures in U.S. history. And it sent the banking industry into a bit of a tailspin. It was a crisis moment. Luckily, it didn't devolve into broader implications for the banking system. Consumers broadly didn't start running from banks, pulling their deposits. And the banks held up fine. And eventually investor sentiment started to recover. And when I invested in Truist Financial, I intended to hold for multiple years, but the stock recovered very, very quickly. And it got to a point where I didn't really want to continue to holding it for the long term. And now fast forward and the multiple has come down. It trades for about 90% of book value. It had gotten to about 1.1 or 1.2 times book value. Of this group, the ones that you mentioned, Citigroup, I've never been super interested in. They've still got a lot of things they've been trying to figure out for years. Of this group, I would be a net buyer of Truist, and it's actually jumped back on my radar again here more recently as the prices come down. The interesting thing, Lou, about the investment banks here, Goldman Sachs and Morgan Stanley, is if we do go through continued economic uncertainty, these guys could be getting a lot of phone calls. Their investment bankers are going to be in their Rolodex talking deals, because one of the things that happens during periods of economic uncertainty is we get that other side of their business really picks up. So counter-cyclically, they could do well, while the commercial banking parts of the other banks that we're talking about here with Wells and US Bank could be challenged. In a weaker economic environment, there's less banking activity that happens, less borrowing that happens, more defaults, more late payments that banks have to start taking losses, and then they take provisions of their books. So far, we haven't seen a bunch of loan provisions from banks yet so far. So the banks aren't really saying, hey, we're bolstering our balance sheets because we're really worried about the environment. So far, it's mostly been business as usual. But beyond that, it's really hard for me to say that any of these look particularly crazy expensive based on their long-term valuations and their business prospects going forward. So it's a pretty individual choice of what to sell. These are all good businesses. I can't say that any of these I see like significant imminent threats that would cause me to want to be selling them individually. I know you know the sector well too. You want to add a little bit?
Yeah, no, I'm generally on the same page though. I tend not to invest in the big New York banks simply because they are such black boxes. It's just so hard to know what's going on inside. I do like the regional banks. I mean, Wells to me is a little too big, but USB and Truist, those are two fine banks.
Yep.
I don't own any of these personally. I own others kind of in this sector. And yeah, the thing to look at there is most of them are so tied to commercial real estate, and so know the markets they're in and know kind of even the, I mean, so Truist is, well, they're no longer based in Atlanta, but it's the old SunTrust. So there's a lot of Atlanta there. And Regions Financial is another comparable that's all over Atlanta. I'm in Atlanta. I know that. I prefer the banks, the ones that have exposure sort of outside of the downtown where it's thriving. You can actually get on that level and get commentary on that. And I think you can find winners in this group. It's just kind of, for a lot of them, this commercial overhang, the commercial real estate overhang has been a question for them. So you kind of really should dig in deep and pick your winners just based on what you can tell of their book and how their book is performing. But definitely, I do think that there are ways to win in this sector. And you're right. You get some decent dividends as the stock prices go down. If you can time the purchases right and time the cycle right, companies that can outlast the cycle, you can get good opportunities to get involved in those.
That was actually one of the big reasons Truist was one of probably 5 regional banks that I bought back in March of 2023. Was because of that dividend. The dividend yield now is almost 5.2%. And back then I bought it, I believe it was in the 6s, maybe around 7% or more. It was extremely high. And based on the quality of their earnings and the strength of their balance sheet, I had very, very little concern about the dividend being cut. But even if the dividend were cut, I felt pretty confident in the margin of safety and the price I was paying, that over the long term, it was still going to be a profitable investment. But knowing that you don't know with bank crises, and we were still talking back then, right, about a hard landing with the economy, I went into the investment with the idea that I can hold this as long as I need to hold. As long as the business quality is fine, I'm willing to hold this for an extended period of time. And the dividend was part of that. It's like, you know what? I can get paid along the way. This is an ideal opportunity to take on some risk that I'm running towards a fire that I'm going to get burned. And it worked out. But again, we're in a period now where this is a stock to buy and not necessarily to sell. If you're concerned about near-term risk with banks, you probably shouldn't own banks, because when the economy does turn, when these crises happen, they happen quick, and the market is always looking forward, especially at banks, and they will fall fast when they do begin to fall. So just caveat emptor, when it comes to banks, you just really have to be conscious of that.
Yeah. All right, let's bang some out real quick. Bestie says, are there ways to invest in Chinese aerospace? Comac. Comac is interesting. They actually have a clone of the 737. I will say, I think the hype in there is a little overstated. I don't think we're going to see Comac jets, at least in the Western world, for a while, but they do have a credible product. Unfortunately, besties, I think I'm right on this. If you are in the United States of America, it is illegal on both sides of the border for you to invest in Comac. The U.S. government has designated Comac as owned or controlled by the PLA, the Chinese army, which makes it restricted there. And also the Chinese restrict foreign investment in key sectors. There are fringe ways around the supply chain to get into that, but it's not really worth it, because most of the ones that you could get into, you can't they're not as big enough part of COMEX supply chain to really move the needle if COMEX succeeds. Dylan Lawson said SoFi really recently announced investment in ARKVX, which is the ARK investment fund that is a private company fund. Their holdings are things like OpenAI, their SpaceX. Any thoughts on this fund? I should say before I start here that these are only my thoughts, and I think there is a case to be made. I personally don't have an interest in this for a couple of reasons. For one, there are really, really, really high fees here. You are paying 5 to 6% for the right to have them do this, and that to me, for an investment that's really out of my control, you can do a lot better than that. This feels like, if I'm honest, a product that was
Money grab.
designed to be marketed. Yes.
Yeah.
Or I mean, you're much less polite. The other thing, just to
I'm not
remember,
going to be polite about it. I'm going to be honest. We're here to be honest with people.
yeah. To me, this is a really good way to take money from people who are excited about trends. The other real problem with this is that there are private markets for these things, and there are employees who want to sell. So there are ownership interests out there, but they are not mark to market really. You are not really, in my mind, gaining exposure to these companies' day-to-day valuation. Over time, if these companies go up from here, then you will, I guess, benefit. But all of these companies have really, really high valuation to begin with. But basically, these things, because you're not, like in a normal ETF, you can get an idea if it's only holding public stocks. You can look at the values of the stocks and its holdings at the end of the day and sort of have an idea of what this thing is worth. With this, you are basically, it is trading on sentiment. It is trading on desire to own it. And for stuff like that, that is just so far out of my realm of how I can really value something and know what I'm owning, even if the expenses were lower, I would probably opt out of this one just for that reason alone.
Yeah, from the SoFi angle, I think the interesting thing here is that this is something that SoFi is letting people invest in through their platform. And I will say that when it comes to the investing platforms and different investing products, I think they do have some responsibility around what they allow people to invest in on their platform. But I also think that it's not their job to police it or to completely apply ethical or moral or how risky is this like standard. I think they should, their role should be to prevent the entities behind whatever that asset is from harming their investors, but it's not their job to protect their investors from harming themselves. Right.
Yeah.
Largely. I mean, there's some nuance there, but largely. So I have no issue with SoFi or other platforms allowing investors to choose to invest in something like this.
Yeah. But just understand what you're owning. Yeah. That doesn't mean you have to either.
Yeah.
Yes.
No, that's exactly right. So Lou, we got 6 minutes and change left here. Ajit Jain, and I love this. There's another one I want to respond to in just a second, but Ajit Jain is joining us. So those that don't know, Ajit Jain is one of the greatest executives in the history of Berkshire Hathaway. Has run a lot of their insurance business and basically built the reinsurance business, and also has some of the best quips, by the way. But Ajit Jain, I'm assuming this is absolutely the real Ajit Jain.
I have no reason to doubt.
Is where else to come besides Lou and Jayson? Is the correction set in, or is it too early to say correction is over, or is this 2-day bounce the dead cat bounce? So all of those things are questions about where we are in the market volatility. Before today, the S&P 500 was down about 9.5%. So it was right on the verge of the correction, that 10%. We know the NASDAQ had fallen more than 10%, but we started to see a little bit of a recovery. We don't know. We don't know what is going to happen. If I knew the answer to this, I wouldn't be filming from my home office. I'd be filming from my private island, right? Via satellite. So the bigger question to answer is, and this is a rhetorical question that I'm asking that everybody should be asking themselves. Have you built a framework and a portfolio that both insulates you from continued downside volatility and unlocked your investing superpower. I'm going to say this every day on Fool24. Your investing superpower is your time frame. It's how long can you hold? And turning these downturns into opportunities versus risks, a lot of that is asset allocation. It's not holding wealth in stocks that should be money in the near term. You're in retirement, or you're about to send a kid off to college or trade school, or you've done really well, and it's time to buy that Ferrari, ticker RACE, or your boat, or whatever you want to buy, and you want to do it in the next few years. You shouldn't have that in stocks, because we don't know. We can't predict with any reliability what the market is going to do in weeks or even the next few years. But we do know, when you start measuring it in decades, our probability that the market is going to gain in value is much, much higher. So using that to unlock your ability to leverage downturns is so powerful. And as a net contributor and somebody that has that margin of safety, I want to see stocks continue selling off, because I have spare capital to put to work. But for all of my foolish friends out there that are living off of their assets, I don't want to see that happen, particularly those that haven't built that asset allocation to remove that risk for wealth that they're going to need to deploy in the near term. So that's really all I can say about it. Is we don't know. Build yourself a portfolio around making that not a risk and an opportunity.
And the only thing I'd add there is that you can never figure these things out based on one day, are we red or are we green? Because even in massive sell-offs, there's green days, and even in great rallies, there are red days. So we'll see.
Yeah, no, that's exactly right. So this was maybe my favorite question of the hour, and now I can't find it. Give me just a second. Where's it at here? Who asked the question? Okay, here it is, right there. Quentin asked, "What are your thoughts on the 1 to 3 year outlook on luxury brand stocks, Ferrari, Race, and VIK?" What is VIK? Why is it? It's right on the tip of my tongue. What is that? That's
is that Viking?
Yes, the cruise ship company, right?
Yeah.
Viking Holdings. I love that, because Tyler and I earlier, we were talking about, I pointed out that Tesla is one of the very few automakers that over the past 10 or 20 years has generated market beating returns. And he threw a Ferrari out there, and I said, bro, come on, Ferrari, that's a luxury brand. That's their successes as a luxury brand. So again, 1 to 3 years, Lou, that's very, very difficult to project, especially I'm looking at Ferrari's incredible business results in recent years and a relatively high valuation that they've generally earned, but that high valuation is also counting on continued earnings growth from here. And it's hard to say how's that going to play out,
Yeah.
Because a big part of their model that they've built is people wanting to buy their most elite, rare vehicles. To even be in the running for that, you basically got to buy a Ferrari every year for 10 years. And can they continue to do that without there being some brand fatigue that potentially erodes their earnings, because they can't sell a car that costs them $500,000 to build for $3.5 million, right?
Mm-hmm.
Because that's where their profit lives. So that's my biggest question about Ferrari. Viking is an interesting business. The caveat, of course, is that it sits right on the front edge of the consumer discretionary market that could be upended in the near term if we do go through a period of economic weakness. I think the thing that maybe insulates that business a little bit, Lou, is the fact that they do tend to draw in a little bit older clientele, so maybe more retirees, people with a net set level of income, and that are maybe a little more insulated from downturns and are still going to go take those river cruises. I may be wrong about that, but I think that does kind of insulate the business a little bit. Any thoughts on those two?
I also think Viking is in the earlier stages of its growth curve.
Yeah,
so if you
true.
had to get me to do just a bar bet, I would pick Viking to outperform. But I will say, and this sounds snitty because 1 to 3 years isn't not time, but honestly, any money I need within that time period, for me personally, is out of stocks. And I hate trying to predict an outlook over 1 to 3 years for anything. But yeah.
Yeah.
With
no,
that, we have
absolutely.
someone who has built a really, really successful long-term
Yes.
company, someone
Yes.
named Mark Benioff. I
Uh-huh.
believe we have an interview with him now,
We
right?
do. Mark Benioff, Mark with a C, co-founder and Salesforce CEO. This is, I believe, with Motley Fool Money host, podcast host Dylan Lewis, I believe, did this interview. So
Mhm.
with that, Lou, we're going to fool off. So fool on everybody. It's going to be a little video. It's going to play for a second, and then we'll transition over to that interview with Mark Benioff. And are we transitioning off of YouTube as well, I believe? I think it's the end of the YouTube time too. Is that right? No, we're staying on
No.
YouTube. So that 1 more hour. That's right. It keeps going. That's right. Still going. So enjoy this. All of the YouTubers out there as well. So again, there's going to be a transition video, and then we're going to get the interview playing. So this was recorded back on March. This was pre-recorded a couple weeks ago. So I'm going to shut up. We're going to hand it off to Mark and Dylan.
Benioff is the chair, chief executive officer, and co-founder of Salesforce. Under his leadership, Salesforce has become the pioneer of cloud computing and one of the largest tech companies in the world. Now he and the company are helping usher in the next era of artificial intelligence. Mark, thanks for joining me.
It's great to be with you, Dylan. Thanks for having me on your podcast.
I'm excited to have you on because you are one of the most authoritative people on one of the biggest themes out there in the market right now. AI was the theme of 2024. It is continuing to be the theme, although it's shifting a little bit. I think we've seen things move from a real focus on strictly generative AI to a little bit more of a focus on agentic AI. And that is where Salesforce is really living right now. Can you kind of walk us through that transition and what you're seeing in terms of development there?
Oh, yeah. Well, Dylan, you already know this is the most exciting time I've ever had in my career. And this is also not our first AI rodeo. You know, we've been doing AI for more than a decade at Salesforce. Predictive AI, machine learning, machine intelligence. Our Einstein platform is probably the largest, most important enterprise platform for AI in the world. We deliver about 1 trillion enterprise AI transactions every single week. And the generative revolution has just been incredible. What we've seen happening with these large language models over the last 2 years is really astonishing. But I think for a lot of our customers, they've been very disappointed with a lot of the solutions that have been kind of given them or even shoved at them. Even Microsoft has really disappointed so many of our customers with what they call Copilot. And instead, we have a different approach, which is the next generation of our platform that we call Agentforce. The idea that you can really take and create something that we believe is going to be the largest and most important transformation of the entire tech industry, which is the digital labor revolution. And the digital labor revolution is like a 3 to 12 trillion dollar opportunity. It's really different for people in my industry. We're mostly people who just help companies manage and share their information. We do that really well. Customer information, all kinds of apps that we have to help companies manage their information. Now we're really stamping out digital workers at scale and giving companies the ability to manage digital employees alongside their human employees. And that is very different, very exciting, and really the next level of our entire technology industry. This is a moment that none of us will ever forget.
I want to dig into those digital employees and the idea of these digital agents. As you guys are rolling out Agentforce and having more conversations with your customers around it, what are you seeing in terms of adoption, and what are you hearing back from your customers in terms of what's useful and what's not so useful?
We've never seen a product or technology take off at this level. We just reported our quarterly results. As you know, we just had our first $10 billion quarter. We're the second largest software company in the world behind Microsoft. And the fastest growing product that we have in our product line is Agentforce. Now, we probably did about 5,000 different types of Agentforce transactions in the quarter, 3,000 of which were paid transactions. And we did about 9 digits in total contract value in Agentforce. Now, why it's important is we're already starting to see customers deploy it. It's getting deployed at a much faster rate than we've seen other products. And even this morning, I was buying some new shoes from Vans. So I went to vans.com on my phone. Here's my phone right here as a point of evidence. And I could probably bring up the site. It's probably still on there. And I'm getting ready, and I wear a really wide shoe. So I just got on there, and there's 5 icons at the bottom of the, Van site now. And the middle icon is the agent icon. You click on agent, and you have Agent Force, and that is deeply connected through their whole company. So, I'm very interested in, hey, what are the wide shoes, and which shoes are going to be the most comfortable for me? And also, hey, I need support on returning shoes that I just bought, and I need help here, I need help there. And the agent is able to kind of work out and resolve all of these things for me. That is what is really cool and exciting. And hey, what can I say? This is happening faster than I expected. I didn't know that was going to happen. And the CEO of Vans is somebody I've known for a long time. Used to be the CEO of a tech company. It's a company called VF Corp. They're an amazing company. And I'm like, wow, this is unbelievable. And he said back to me, well, people are telling me this is the most exciting thing that's ever happened on our site. I'm like, it's hard to put it in context what is happening, because instead of having to call someone Vans, someone to email someone in Vans, I'm able to work with a very intelligent, digital worker who's helping me to complete my transaction, to get the kind of customer service and support and all the things that I need. And that is very exciting. And that is what I am, motivated by every single day now. And I've got so many customer stories, and that one I just found randomly this morning when I got up. So I'm like, let's just keep going. It's so cool.
As someone who wears a 12 EE, I'm appreciative of everything that you're doing for my shoe buying
Well,
experience.
you should try this. You should go and try you'll see they've got a really nice, cool, wide shoe on their site.
In the recent call, you talked a little bit about the trinity of apps, data, and agents, and I think maybe in that answer on Vans, you talked about it a little bit. But can you walk through how those pieces are coming together for customers?
Yeah. Well, I think people keep coming to me and asking me that very question. They're like, why is it that you're all of a sudden the #1 agent provider in the world? And why are your agents so accurate? And why are you getting traction? Why are customers saying, yeah, that you're ahead? It's very, very simple, actually. There's 3 things that have to come together to make AI work in an enterprise, whether it's mine, and I can tell you my own personal story, or Vans. It's one is, we're still here. The humans are still here. So I might be the last CEO who only managed humans. Now all CEOs are going to be managing digital workers and human workers. But we're still here, and I still have lots of support people, lots of salespeople, lots of marketing people, and they're working with my customers, but so are the agents. So even in my own site, which is help.salesforce.com, and in the quarter, I did like 500,000 or 600,000 customer support conversations or something. I do maybe 60 million a year in total. The thing that's interesting is that in those conversations, about 84% accuracy by the agents answering the question. Very cool. Then there is 2% escalation to the human workers. And those workers have to then get that information right from the agent. And then those agents and humans are working in tandem together to resolve the customer issue. So that idea that humans with AI are working together, that is why Salesforce is so important, because we're not delivering something separate from our platform. This is a clear and absolute extension of what we're already doing. So our apps are extended with the agents. And then we have all of our data together in one place. Now, we have made a significant architectural change in the last 24 months with Salesforce. We broke it into exactly what you said, a trinity. And the trinity is, #1, the apps. So all of our apps are written into a common core and work together. It's a common framework, which is our Customer 360 apps. 2, we have our data cloud. which is aggregates all the customer data together and then federates it through zero copy to all the data sources throughout the company. And 3, we have the agentic layer on top of that. So the apps, the data, the agents, but it's only one piece of code, Dylan. It's one piece of code. Even I'm explaining it as 3 tiers, but it's really one piece of code. And it has to be one piece of code because it's one piece of data. And that's why our agents are so accurate. They can see all the data, the metadata. The metadata is the data that explains the data. Like the data is the phone number. The metadata is this is a phone number. Because we have that information, that is what is so exciting. And we have this incredible opportunity where we can, basically deliver accuracy with AI. And that is, for me, like, for example, in the quarter, those, customers who are coming to help.salesforce.com, the velocity of it is awesome. But if you look at it a year ago, I didn't have that. I had, kind of the typical FAQ, and I had the customer support app, and I had 9,000 human agents. Now, I'm not going to need as many human agents anymore. I'm just not. So I will be able to rebalance, and you can see it. I put the stats right on the homepage, so you can see what I need and what I do not need. And it's a transformational moment for us, for our customers as well.
Earlier, you mentioned Microsoft, and I'm going to take the bait there. You're not alone in pursuing this type of technology. They are also announcing that they have agents out there. They are trying to work that into a lot of the software they bring to their customers.
Yeah.
When you think about these offerings, what do you see as the differentiators?
Yes.
And what are you really competing on?
Well, I think they're, obviously we've kind of changed the conversation, as you can see, that before it was about a co-pilot, and they repackage and resell ChatGPT as their AI solution. They don't really make one yet. They're trying to make one. They they're basically an OpenAI reseller. And I think the problem is that for a lot of the customers, they've had to kind of DIY that into what is a complex enterprise architecture. And it has not exactly worked. I mean, you can talk to the customers. This is why we have like a stream of customer stories now. And I think that the reason that's happening is we've just extended our core platform. We're not really asking customers to add anything new. We're just asking them to turn it on. And I was with one of our, largest customers is an airline in Singapore, Singapore Air. We've all heard of it. And the CEO Go is amazing. And, they've been a customer for a long time, great relationship with the client. And they're like, yeah, we're just turning this on. This is amazing. We now have an agentic layer around the entire airline. So we can do sales, we can do service, we can do marketing, we can do all of these things. And that is really cool and really gives us, this ability to augment their workforce. And they're shocked at how fast they can install it and get it going because they're just flipping a switch and turning it on. This is different than that Microsoft approach, the co-pilot approach. First, Microsoft Copilot, and we talk about that. Customers realize it's not just one co-pilot. They have a dozen co-pilots on all their different product lines. None of them are connected together. It's not one source of data. It's not this kind of one piece of enterprise code. It's a real hodgepodge approach. And that's why it's failed. And I think our approach is much simpler, easier, and more successful with, real customer success because of the architecture. And I think it's the architecture that's making it different. It's that ability to deliver that, high quality semantic layer on the data that's really giving us this capability with AI.
I think digging into last quarter's results, you said you had, I think, something on the order of about 3,000 customers paying for Agentforce. As an outsider looking at the business, is that what we should be monitoring for growth, adoption, and you guys making progress on that roadmap?
Well, not exactly, because I'll tell you how we're looking at it. we're signing up such a high velocity of customers. Even today, we have a conference going on, which is Trailhead DX, and we have thousands of customers, in San Francisco, and we're turning so many on. But it's not just about turning them on, signing them up, getting the contract signed. It's none of those things. It's really about adoption for us. So we are at the moment where it's like when I turned on my phone this morning and Vans is running. Or another great story is Remarkable. There's this pad. It looks like a computer, but it's not exactly. It's like a note-taking pad, and it's a very fast-growing company. And Remarkable, it's an amazing technology. And, I have the product. It's fantastic. And if let's say you're using the stylus, and all the time I lose the stylus. I'm just a forgetful person. I don't know where my stylus is. So then I have to get on there, and I'll say to the agent, I'm using Agentforce now, and you can try this right on remarkable.com as well, and say, hey, how do I get another stylus? How does it cost me? How do I ship? All of the things that I would normally have to talk to somebody or try to like cruise through the website, it's all getting handled for me by the agent. And again, that is a huge change. And you have to remember, we only released this technology in October. So if we're talking about whether it's Vans or Salesforce or Singapore Air or Remarkable, these things are like very new. So we're just counting live. We want to know how many live do we have. And we're trying to get as many of those ones that we've signed into live as fast as possible. Now, that focus on adoption and customer success, that's not new for Salesforce. That's how we operate our business. This is, we're in a subscription software world, so we want people to use the product. This is very important to us. And we're seeing this across the board. Another story, I have this great relationship with the CEO, Dave McKay, at RBC Bank. They're in Canada. They're one of the 6 largest banks in Canada, maybe the largest. And they have a fantastic AI team. A lot of them came out of this great university in Canada, Waterloo, that does all this incredible AI technology. A huge fan of the team, the technology. And they're like, listen, Dave, you got to let us do our work. And I'm like countering, saying, hey, Dave, let us show you what the platform can do and the speed of delivery. They're already a huge Salesforce customer, thousands of agents and salespeople. And so they incubated it in their wealth management business, which is in the US. And they have this great executive there, Dave, and he has kind of taken this Agentforce platform, and he augmented the bankers, he augmented the support agents, augmented the call center, and all of a sudden they're getting tremendous productivity from that. And it is a much easier way than the DIY approach that even a bank like that was pursuing it, because they have so many developers and so much technical capability. You can see why they would do that. And they're awesome, but our platform is a better approach. And it's going to give you a better, more accurate, more easily deployable system.
So the examples you ran through there, some of them are talking about how customers and businesses interact. Some of them are looking at how companies themselves operate. And I think with artificial intelligence, one of the big things we've had to acknowledge a lot in the last couple of years is it is going to change the way that a lot of businesses work and the way that a lot of companies work. I saw that Salesforce isn't planning on hiring engineers this year. How do you see agentic AI playing into the way that work gets done for you guys, but also for a lot of your customers?
Well, I have a lot of software engineers, probably more than 10,000, maybe close to 12,000 now. And, they're a huge part of our workforce. We have 75,000 employees, but I've noticed they are just so much more productive using these next generation of tools. There's so many new next generation productivity tools. And in that same way, humans will be augmented. In the example of Gucci, we took our technology and we applied it to a call center in Florence, Italy. And we augmented the call center. And it's really incredible what happened. All of a sudden, we were like, okay, are they going to need less support agents? it turned out revenues went up 30% in the call center because the support agents were able to sell products, market products. They could understand products that before they did not have or understood. So that was awesome and incredible that we could make their revenues go up and make them more profitable. We've seen the same thing happen in a company in Miami called Lennar. Do you know who they are?
No, I don't.
They're a huge home builder in the United States, maybe the largest or one of the very largest. And they have two great co-CEOs, Stuart and John, who I've been talking to because their team came to Dreamforce, which is, our annual kind of powwow, Lollapalooza conference concert. We have like 40, 50,000 people come to San Francisco for that one. Their team came. They've been a customer for 8 years. They do sales and service and marketing. They do all these amazing things. So the team came back to Miami and they ran a hackathon to look at how could they use Agentforce inside Lennar. And what they found was that there are 5 critical use cases. And if they could do it, they could potentially generate hundreds of millions of dollars of more profit, huge amounts of revenue, and basic things like being able to provide an agentic layer on all of their home sales that are 24/7, lead management, selling, new products to existing customers like insurance or mortgages. And you can not have to have a very big fantasy to see, wow, there's a lot of things these agents could do because it's just hard for them to hire more workers. So they're really extending their workforce, their human workforce, with these digital workers, and it's a digital labor revolution. So for a Lennar or for any of these companies that I mentioned, it's an extension. In some ways, it is a transformation. Another company in Florida that we work with very closely is Disney. And for Disney, of course, it's augmenting not just like the Disney Plus call center, but it's also kind of really providing a different kind of interface for, first of all, the employees, their cast members. The products at Disney are so complex and so deep, and they have so many, that when cast members are trying to understand all the products and trying to communicate to the customer, they need tools to do that. That's number one. But the second thing is the ability to deliver an agent that can talk directly to the customer on a complex product configuration. Like, for example, I'm coming to Disney World. I want to have a really incredible hotel room. I also want to have a restaurant reservation. I have an allergy. I need to make sure that the restaurant knows that when I get there. I also want to make sure I have all the accompaniments for the park when I get there, like the right park pass, the right promotion, the right additional Disney guide. All of the different products of Disney, they start to get bundled together into kind of a custom SKU for this client who's coming to the park on vacation for the, with their kids. Wow. And they're humans. They do have a hard time putting it all together. The agents can help, and the agents can talk directly to the customer. And you can see this even on our own website, at any moment, the customer, boom, can move over to a human agent. And then a human agent gets a screen because we're all operating in the same app, the same data set, right? It's that same trinity. And then the human is looking at, oh yeah, I can see, here's the client, here's the allergy, here's the hotel, here's this. This is not some kind of thing that I'm just making up on the fly. This is something that we've built, that I've seen, getting deployed, that I'm excited about, that this can be really is possible. And maybe a year or 2 years ago, it was not possible. So we really have made huge strides. So whether it's that hospitality or media company or financial services company or consumer product goods company or airline or clothing company or tech company, every single company can benefit from this technology. And that is why this is going so fast.
You just talked about how this was something that you guys built. And I know historically, Salesforce has been a mix of you guys home grow some stuff, you acquire companies that look interesting and make sense as part of your overall suite. in the AI zone, is that something where you guys want to focus more on home growing, or are you still looking out there and seeing what opportunities might be there in the market for you?
We believe that there is, for a high growth, high quality tech company, the perfect balance between organic and inorganic innovation. Even in the example of Agentforce, I was able to accelerate it because we already had the vision. We knew what we wanted to do, but we knew we needed to have an extended team. We wanted some technology that we did not have inside. So, you know, 8 or 9 years ago, 10 years ago, I bought a company. It was an amazing company that we integrated deeply into our product that became Einstein. The founders of the company left after about 5 or 6 years, and one of them started a company that we invested in. And then about a year ago now, I bought that company, and it was kind of an aqua hire in one level. That means kind of just hiring the people. And another level, I kind of like some of the technology they had, but I knew I could simply and quickly extend my platform with it to bring forth our AI in a new way, and that is Agentforce. So acquisitions are important. In other areas, we've entered new markets and we have critical products like Slack. A lot of people use Slack. It's a huge product, incredible. He had a huge growth year last year. And one of the reasons why Slack is growing and more relevant than ever is it's an incredible place where your agents can live. In fact, I just retweeted a developer came along this morning and said, hey, I can see how Slack is going to become this place where all my agents are now operating. I'm communicating with them, and yet they're all collaborating with all the other workers in our company. So that's very exciting for us. So Slack was an incredible acquisition. Tableau is another one. Now, a lot of folks haven't seen the new Tableau yet. It's called Tableau Next. I have always loved Tableau. It came out of Stanford. They did this amazing work in business intelligence and analytics. Always wanted to buy the company. Finally had the chance to do that. The product is awesome, but yeah, we're moving into the agentic world. So I have rewritten it. I rewrote it over the last, basically a year. In that case, I don't need to acquire it. I already had it. But now Tableau has a deeply integrated agentic layer, data cloud, and app layer, just like we've been talking about. When Tableau users see this coming up in the new conference, they are going to honestly flip out. They call themselves the data fam. To see the next generation of Tableau, that it could have another decade or 2 decades of growth ahead of it with a new architecture, is really exciting, not just for me, but I think for the entire community. And I'm really excited about that. The new Slack, the new Salesforce. And I think refreshing our whole product line with this Trinity approach, rewriting everything into this architecture, this is transforming our company and our customers. And we're going to see a lot of new, exciting deployments this year, and refreshed deployments of what was already deployed getting extended.
I'm glad you brought up Slack, because I was going to have to ask you about it. It's the biggest acquisition, and Tableau also something that has a lot of brand recognition. We've used at the Fool, and I think a lot of people who follow the software space know well. Now that you've had a little time with both those, I'm curious, how would you grade those acquisitions with the benefit of some perspective, and what's the work to be done there that you still see?
Well, number one was Slack. I could give you a lot of class on acquisitions. I've done more than 60 acquisitions. So, it's 25 years of Salesforce, more than 60 acquisitions. And so there's a lot of lessons. But I think the newest Slack, number one, when we bought the company, great brand, great product, great team. I think that the team that we acquired had a slightly different vision of the future than we did, and why we bought it. They were struggling, competing against Microsoft. They didn't understand how to differentiate themselves. There were issues, which is why we were able to buy it. Otherwise, we wouldn't have been able to buy it, because it was incredible. I think they were on their way from 1 billion, on their way to 2 billion. Now the thing is on its way from 2 billion to 3 billion. And we have a different vision. We have a different architecture. And they're going to benefit from being part of our architecture because they want to be part of our data cloud. They want to be part of Agentforce. And that's what gives our customers this incredible value. Because now, let's take any one of those stories that I just went through, but let's say you are Singapore Airlines and you do have Salesforce as your platform, and you have these agents, and you have this agentic layer, and you are doing sales and service and marketing and commerce and all these things. And now you also have Slack, so your employees are collaborating in that. It's all working together. And that is what is cool. And that's why I love the new Slack, what we've done with it. We're showing that off today at Trailhead DX, for example. Customers are loving it, tweeting about it. We're showing off some of the work. I mean, this is what, gets us excited, is to innovate, to create, to, conceptualize the future. And what I love is, you can take some of these brands that they may not have a clear trajectory without us, but then you bring them into our architecture and it transforms them and gives them not only an expanded customer base to sell to, because all of our salespeople now are selling Slack, for example. So we have a huge sales force selling Slack, where before Slack only had, a couple hundred people selling Slack. Hey, if you're going to compete with Microsoft, you need a company like Salesforce who, A, knows how to market and position against Microsoft, but B, can sell directly to customers. I was just talking with one of our largest customers yesterday, the CEO of a large pharmaceutical company, great company. I use their products myself. I wear contacts. There, I use their contacts. And, he's a huge Slack user, running his company. And, I was telling him how excited I was about the new Slack and what I thought was going to happen and what he could do now that he could not do before. So I was really happy about it.
Yeah, I'm curious with Slack in particular. You have a portfolio of offerings, and the idea is, you can naturally extend ones you already have to users over there, but ideally, whatever you acquire also creates inbound new users for all of these other things. I imagine, especially the way we use Slack here internally at the Motley Fool, there's probably a little bit of a stickiness to Slack that doesn't necessarily exist for a lot of the other major communication tools out there. Like, what are you seeing as Slack as a front door to being able to sell the rest of the Salesforce suite?
Well, there is no more modern, more capable collaboration platform today than Slack. And if you are a user, I hope you've turned on the AI functionality and seen some of the cool stuff like recap and the summarization thing, but also how agents can directly appear, the huge amount of new agent platforms that are appearing in the Slack ecosystem. I also personally had this huge vision of being able to do systems of record within Slack, which we now call Slack lists. So you can use Slack as a data manager, all that's directly connected to Salesforce. There's also now Slack components that directly transpose your Salesforce information, so you can operate Salesforce from directly within Slack. You can operate Slack from directly within Salesforce. So if you're a Salesforce client, your Slack is appearing just directly within Sales Cloud and Service Cloud as well, or any of our apps or a custom app that you build. And then as we look to build new apps like ITSM and new kinds of capabilities, we're doing that all with Slack first. So, Slack remains, I think, a really competitive and modern user interface for the world. And so we've invested a lot. We've transformed it a lot since we bought it. But the architectural transformation is the biggest transformation. There's a lot of new exciting versions of Slack coming with new extended capabilities for search. A lot of that you'll see between now and Dreamforce coming up, which is coming up in October this year. I think there's incredible trajectory coming for Slack. I just hit through 2 or 3 really important things, like the idea for agents to be able to live and interoperate in Slack, the marketplace, the ability to build system to record applications, and a single system of search between Slack and all of our apps. These are like major priorities for us internally. They're very straightforward development and engineering goals, all made better by Agentforce. So that's where my head is at around Slack, and I'm pretty jacked up on it. And I think that the revenue growth last year was kind of evidence of the competitiveness. And I can't remember exactly what the numbers were, but it wasn't unusual for us to all of a sudden see a quarter where we're seeing 20 or 30% growth on Slack on bookings. And I was like, whoa, this is like crazy. And I just feel like, well, I'm living it in every day myself. If I show you my phone, you'll see that it's like, that's how I'm communicating with my company. That's how I'm interoperating. In some cases, it's how I'm putting data into Salesforce itself. So Slack is just awesome.
Mark, I really appreciate the time.
Oh, and one other thing, we're all reading about that whole thing going on, the Doge work in the U.S. government. They're using Slack. A lot of U.S. government agencies use Slack, but Doge is using Slack.
It's everywhere.
Everyone is like using Slack. I'm like, whoa, this acquisition is amazing.
As we wrap up here, we've spent a lot of time talking AI, generative AI, agentic AI. I'm going to ask you to peer into your tech crystal ball a little bit. Do you have a reckless prediction on the direction or the development of AI, whether it's in how customers will use it, how businesses will use it over the next 5 years?
Well, I think we see a few exciting things happening in the industry, and I think people need to kind of reframe how they're thinking about this. Number one, you see these companies putting hundreds of billions of dollars into these data centers, not just one. You, Dylan, could probably list 5 or 10 of them just on your own, without even notes in front of you. And I could too, and I am driving my costs down by, moving my platform to work on as many of these as I can, because I can take advantage of a lower cost infrastructure. I want to be a software hyperscaler. I don't want to be a hardware hyperscaler where I have to build these data centers. I want to have a portable platform that works across all of these data centers. And that's a huge priority for me. And I think that that's a tremendous prediction for the future, which is everything is going to be a lot lower cost to deploy. And that's super powerful that you have companies putting so much of their capital. And I don't want to impact my balance sheet and income statement by doing this. So I'll take advantage of the investments that these companies are making and partner with them. So that's number one. Number two is you can really see, and I've said this quite a few times, and I think initially people didn't feel it was true. But I think now they kind of get it. These large language models are mostly commodities right now and have been. Now, I've been doing models for a long time in AI, and they're constantly leapfrogging each other. We're trying to leapfrog everyone ourselves. It's kind of a fun game that we play in the tech industry. But the large language model game has been won by nobody yet. And this idea that the model that's successful today is going to be the model that's going to be successful tomorrow is not true. So you can see, for example, I'm kind of getting ready to delete OpenAI and ChatGPT off my phone, which is something that I would never have even thought of 6 months ago. But now all I'm using is this Grok app, and it's fun. It's got this crazy, edgy, voice capability. Elon Musk has kind of transposed his personality into the way he's kind of divided up the voice platform. I don't know if you've tried that, Grok 3. It's crazy, right? It's crazy. Everyone's got a crazy story. I did a demo yesterday for a friend of mine. They couldn't believe it. Like this unhinged mode and storyteller mode and all kinds of other crazy modes. And I'm like, well, this is just better right now and more accurate and more fun than the ChatGPT app. Maybe I'm going to delete that off my phone. Why am I paying $20 a month for that? I'd rather be paying for this. And I probably have 6 or 7 of these things on my phone, and I'm getting ready to pare them down. And then, is Grok going to be the best app a year from now? I don't know. Maybe I'll end up putting the ChatGPT back on. Maybe I'll be using, U.com is a great one. Maybe I'll be using Perplexity. I have no idea what's coming. I couldn't have told you this is what was going to happen a year ago. So that's a commodity part of the infrastructure. The LLM, it's kind of like disk drives, disk drives and RAM and the computer. These are all commodity infrastructure components that are being made by large tech teams competing with each other. And that's how we drive our costs down. And that is something that I think is very important, that yes, you have a new commodity part of the infrastructure, the large language model. And when I look at those things, I think the third piece is everyone's saying, hey, AGI is coming, AGI is coming, AGI is coming, but nobody exactly can define it. Nobody can describe it. Nobody can, we can kind of see in these movies, like our futurist Peter Schwartz was a key writer on Minority Report and War Games and Deep Impact, and it's like, okay, let's say AGI is coming, and that we're all going to be talking to, Hal, and saying, "Hey, Hal, open the doors," and oh no, I don't want to open the doors, but the doors, that's not how my doors are working right now. So maybe that's coming, but it's not here yet. So I'm kind of like, okay, I'm willing to be optimistic on AGI, but I also realize, like, what does AGI really mean? I think that for those LLMs, they're great, but we know they don't have 100% accuracy either. They're like we have like the highest accuracy, and the highest we've seen with some of our customers is in the 90s. We're kind of in the mid 80s ourselves right now on our own deployment. We're going to try to get into the 90s, but we're not going to get to 100 because the way that the thing is architected with these words are all hooked up with each other, and then they kind of turn into these kind of spider, neural network words. And these ideas aren't going to give us the 100% accuracy. So new models will have to come, new AI ideas. And, nobody's going to want an AGI that's only 50% accurate.
Yeah.
That's going to cause chaos. So maybe AGI is just going to mean 100% accuracy. And when will we get there? I don't know. So there's some fantasy of what the next generation is going to be. Maybe it's going to be a multi-sensory model, a world model, where you can, it's a 3-dimensional rendering model. But those are the three things I would say. One, much lower cost infrastructure, that we're all going to be able to ride on. Two, commodity LLMs. And three, yes, these future states that are very exciting. And I hope that we get there. The future is definitely coming, and we've seen the movies, and we all want that to happen. It's going to be exciting.
Well, Mark, if you're game in a year, we'll have you back on to see which
anytime.
phone app you are using and also the progress that you're making on Agentforce.
It's great to see you, Dylan. Bye-bye.
Thank you so much for your time, Mark.